Danny Cherrod here from Rye, New York, opening our second day of our Canadian Family Office online conference. So I'm very excited about that. I love our idea, basically because it's our idea, but I love it also because it's a good idea that we've decided to put the events, each one is like 3 hours a week apart. I think people like it. While Adam's panelists are joining, I will say just a couple of words. So basically, we have a great day ahead of us. All of you that looked at the agenda probably already know that. We have a special discussion with the Gaspé family, the Gaspé-Bombian, with both Francois and Philippe. We have an exciting AI session with the heads of the World Economic Forum, AI's practice, and Boston Consulting Group, and Scotia about finance and technology. We got lots of technology, especially our next panel. So just a couple of words about what's coming next. So next week, we actually open our US conference. We do divide the two because of different topics we talk about in the Canadian conference that we don't in the US. That is happening on next Thursday. So November 12th is the first date. Amazing speakers. John Katsimatidis, one of the largest real estate families in the United States, is our keynote speaker. He will be our first speaker. We have an AI session with the heads of AI at H&M, NVIDIA, Microsoft, Levi Strauss. So that's brilliant. We have family members like Rockefeller, like Kennedy, and many others in 2 days of an exciting conference. So that's going to start next Thursday at noon. And then 2 days before that, is it 2 days before that? Yes, it is 2 days before that. We have one of our weekly sessions, this time November 10th, dedicated to a continent we kind of didn't really talk about a lot at our sessions, Europe. So we'll be talking to Gina Miller. She was she's very famous in the UK for fighting against the Brexit, social activist. We're going to talk about everything that's going on there, probably the lack of control of the UK government when it comes to COVID-19, what's going on with Brexit, and many, many other issues that are we're seeing in Europe. So that's going to be an exciting session. So that's next Tuesday at 11 EST. So that's basically what we got coming next. And then our second date for the US conference is November 18th, which is the following week, of course. So that's what's going to happen there. Currently, we are excited about the peace agreement with the UAE that's being spread to other countries. We think it's amazing. It's a little bit of light during COVID days, and especially when it comes to the Israeli side of things and technology. And we believe that that will also bring more families from all around the world, not just Israel, to what we plan on doing there next year. So if anyone wants more information about it, you can let me know. We have from Canada, the Gaspé and the Marret on the board of our conference. Sylvain, which is, I think, probably the most important family on the planet when it comes to an event that's about peace and business with the UAE that we can come up with. So I'm very excited and honored to have them chairing the event. I think it has a lot of meaning. And other very great names that we have on the Israeli side, on the US side, on the Canadian side, and even the Paez family that I spoke to just yesterday from Guatemala, and a special mission coming from there. So stay tuned because we are all excited about what's going to be happening in the Emirates and the family office world. So we will be opening actually now our first session, which is our technology session. And I have here Adam Saskin from Faskin. Faskin has been a big supporter of ours since day one, when we didn't have a track record, when we would send them emails from anonymous email addresses to get their attention. They supported us from day one. They support us nowadays during COVID. That's not taken for granted. So I'm really happy to have Adam Saskin here. and Elias, who was speaking and moderating the real estate session last week. Amazing partners to have. While Orit will try to get Dov Moran to join us, I'll just say a couple of words about a panel from my perspective. These are all good friends of ours. Philip, you're the only one we haven't met before, but I'm sure you'll be a good friend of ours as well. When I was thinking about names for the panel with Adam, I think he mentioned you as one of the most talented folks in the tech scene in Canada. So we are happy to have you with us. And just a couple of words, Liran is a good friend of ours from Team 8. I personally think that Team 8 really is one of the top VCs from Israel. Cyber and AI, they were built by the veterans of Unit 8200, which is a secret unit. I was accepted to that one, of cyber and AI, that's the Israeli Army Division. And Larry Wagenberg, that I had the pleasure of speaking with him as well. He is leading with the Sylvain and Charlie Fetterman, the tech investing arm of Sylvain Properties. Sylvain, I don't think I need to explain too much who they are, and they're doing an exciting job. It's really an interesting model. They have an entire floor, several floors actually, where the companies they invest in are. So I don't know, I'm stealing all the attention. My team is writing me here to stop, but I put them on mute because I do want to say that Dov Moran on the right-hand side, what a lovely guy. I spent many days with Dov in Texas when we went, he spoke at our conference in Dallas, and we spent many days together in New York. I hope you enjoyed them as much as I did. Dov Moran is a serial entrepreneur. He never stops. He invented the flash drive. His company was sold to SanDisk for around $1.6 billion, and really is one of the nicest people I know, and I know a lot of people. So thank you, Dov, for joining. Adam, I stole the presentation part from you, so you now can properly do this and take it from here.
Thank you very much, Danny. I think we're done, actually. We can close it down at this point. Thank you, everyone, for joining us. We really appreciate your time today. As Danny said, my name is Adam Saskin. I'm a partner in which is a Canadian law firm, offices across the country. Really excited about the panel today. I thought as a first step, maybe we could have each of the panelists just spend a minute introducing themselves. We'll start there. So if I go clockwise on my screen, at least, we've got Liran to start.
Thanks, Adam, and thanks, Danny, as well. It's great to be here, and thanks for having me. The pandemic brought quite a challenging time to all of us, but for the ones in the technology industry, it's also very exciting as we're very productive, very busy, and can also bring a lot of value. And me, I'm one of the founders of Team 8. We're a venture group building companies and investing in companies. So not only investing, but also building companies from scratch. So it's a very unique one. Unique model. We're backed by a lot of private LP investors, but also many strategic ones, such as brands you all know of, like Walmart, Microsoft, Airbus, Barclays, Moody's, AT&T, and others. And we bring expertise in mainly in two areas. One is cybersecurity, based on our expertise from 8200. Danny mentioned a few words about that. And also in fintech. Some of our partners on the team were the CEO of the largest bank here in Israel and two fintech unicorn entrepreneurs. And on a personal level, just lastly, started my career at 8200 in the Israeli military as an engineer, then an officer leading some R&D teams, computer science graduate, led some product management at two companies that became unicorn, and started Team 8 back in 2014.
Great, thank you very much. Next we have Philip Cutler on my screen.
Thanks, Adam, and Danny as well. So pleasure to be here. Really excited to share some of my insights as an entrepreneur. Quickly on my background, so I'm the Chief Executive Officer and founder of a company called Paper. We're an educational technology company that focuses on delivering true educational equity to all students. So we partner directly with school districts to effectively allow all their students to have access to a live tutor. My background's in education, so I was a teacher before I started the company. a little bit of a different background than Laurent's, but I really enjoyed my experience in the classroom, but realized pretty early on that there were some strong inequities that existed, particularly around the fact that wealthy families were going out and hiring additional support for their children to give them an edge. And at least in my classes, those students weren't the ones who really needed to help the most. It was the other kind of 80 to 90% of families that didn't have the resources. They're the ones who needed that extra help. Saw that as a huge opportunity, both from a business perspective, market perspective, but also from the impact perspective. Ended up leaving teaching, started the company 6 years ago. We've grown quite rapidly, particularly over the last year or two. We support over 500,000 students, predominantly in the US, some in Canada and a few internationally, but we've been really excited to sort of see the transition that's happening in schools more broadly. I think school closures that happen across the world have really forced our institutions to reinvent themselves and transform. I think this was something that was coming likely in the next 3 to 5 years anyway. It's really accelerated it, and we built a business that was designed for the future of education. And so we're definitely seeing some tailwinds now.
Great, thank you, Phil. Next we have Dov.
My pleasure. So I'm Dov Moran. I'm Israeli, born here, Technion, Israeli Navy as head of the microprocessors department. Established my first company, M Systems, dealt with flash data storage. I'm known as the inventor of the USB flash drive. Brought the company to $1 billion sales, sold it to SanDisk, $1.6 billion. Established few other companies, some successful, some less. Was chairman of Tower Semiconductor, brought it from almost bankruptcy to a level of, to value of several billions of dollars. And in the last years, I moved to the other side. So I'm now an investor. I'm a venture capital fund manager called Grow Ventures. Early stage Israeli companies, not because others are bad, because we are in Israel. We need to look at the other guys at the eyes. Even if it's a Zoom, it's not, we need to see them. We need to feel them. We understand Israelis. Early stage and deep technology. You should ask, what is deep technology? Deep technology is all the essence of technology. It's the hardcore. It's semiconductor and the cloud infrastructure and AI core, which means not using AI, but the AI algorithms or the hardware that is behind the AI. We had the first fund was $110 million completed, amazing results. Out of 14 companies, one was terminated. Almost all the others did follow-on investments with much higher valuations. We have several companies with valuations of hundreds of millions of dollars. Second fund was raised about a year ago, $123 million. Till now, 4 investments that we have done, and 3 out of the 4 investments already got a follow-on investment, which means that financially, the market has money for good investments.
Thank you. Larry?
Hi, all. I'm Larry Wagenberg with Silver Tech Ventures. As Danny pointed out, we have my partner Charlie Fetterman and I have a relationship and a partnership with Tall Carrot and Guy Vardy at Silverstein Properties. They've been tremendous to host us here at 7 World Trade, where we invite many of our companies to sit with us. We typically work with them before we make investments, and we work pretty closely and get to know them before we make investments. So we've sort of turned the diligence process in reverse. But that's enabled us to build really close relationships with founders and CEOs and their teams. We did not start out being very Israeli, or with the intent of being very Israeli, but I think about half to 2/3 of our companies have Israeli founders as they've moved their headquarters to New York. And we still see some of them in the office. They're behind me, but it's been harder for them to travel back and forth. So we're looking forward to getting through that.
Thank you very much. So to jump right into it, the first question for all of you is, how have technology companies adapted to COVID, and what have some of the biggest challenges been?
I'm happy to jump in as an entrepreneur, like many of us, and talk about our experience over the last 8 months, really. I'll start by saying, welcome to my basement. I think this is reality for a lot of companies, right? We moved from pretty quickly from being in an office setting to being fully distributed remote. In our case, we had an office in Montreal, an office in Los Angeles, and now we don't really have anybody going into an office. That's been a pretty quick change. Fortunately for us, we were like a relatively agile tech company, and so the transition happened overnight. We basically told everyone, don't plan on coming back to the office for a while. I was back in March, and it allowed us to adapt. We were pretty apprehensive in the beginning in terms of how departments would evolve. The reality was, though, I think we've actually improved our overall efficiency almost across the board in every department, because you're commute time, all of these things that were a loss of inefficiency before just don't exist anymore. So everybody's able to really get a lot done. In our particular industry, I mentioned it, in my introduction, but schools have transformed, right? Like, we're seeing growth like we could never have imagined. We were already growing quickly, but this transformation has really forced school districts to reprioritize. And that, those are our customers, but I think it's really forced all businesses everywhere to reprioritize every dollar that they're spending. And that money needs to be spent in the most efficient way possible, which opens the door for innovation. It allows you to have these conversations that say, hey, the way you've been doing things is highly inefficient. And I get that that's how it's been for a long time, but it doesn't make sense going forward. And given the economic instability and uncertainty with the virus and everything that's gone on, if you're a business that really has focused on the future and innovation and helping people become more efficient, you're going to see tailwinds, you're going to see explosion. And from our perspective, we've really blown up this year. And we've seen this in other companies, across many verticals. But it's all the ones who had this mindset of the world is going to change anyway, and supporting other businesses on the B2B side or even consumers to making their lives more efficient. Companies like Peloton, stuff like that, they were already thinking, the world is changing. This has really accelerated that. So, I think there's a lot of businesses that's impacted negatively, for sure. You think of travel and hospitality, but it's also forcing some of those industries to rethink themselves too. I think, for the venture side of things, it's going to create a lot of opportunity for some really, really fast growth in businesses. And we're going to see some companies that emerge in the next, 12 to 18 months that no one's ever heard of, that are just rocketing, because of the way things have changed, and capitalizing on that is key.
I'll chime in to say, similar to Philip, the transition to working from home was incredibly smooth, but we were surprised by it. Although we're all cloud-based and everything, we thought this will be a much more challenging task to do because we're an organization that works from the office every day. But everything just worked, which is a great testify for technology generally that we have in the world today. But to the question on how the companies adapted. So first, there's the part of managing the risk. And from a venture capital standpoint, we followed, a thumb rule of going through the portfolio company and the various portfolio companies with a thumb rule that at the beginning, with uncertainty, assume 2 years of no fundraising. And startup companies, of course, are not profitable. They are relying on fundraising every year and a half or two. So one company at a time is assessing where we are and where we needed to do the fundraising and adopting accordingly. Some will just stop hiring and it buys them the few more months of dealing with it. Some will need to do more dramatic moves. And some were, for example, in our portfolio, there was one company that was actually going to go out on the next fundraising at March, heading, 6 or 8 months of capital run rate until end of cash. And that's the worst situation to be in, assuming something will bad. Specifically, in this company of ours, and in April, it raised $23 million in A round. So it went amazingly well because it is an amazing company. And luckily, investors were there and didn't disappear. But for others that we've seen around ourselves, not a teammate, these are the kind of companies that needed to do hard decisions and potentially layoffs if they can't indeed raise capital. It also introduces a lot of opportunities for investors. There might be a question about that later on. Like other companies, we invested a lot in helping the portfolio companies to adopt their employees to working from home and taking care of, the employees' health and mental health, and make sure they have the right working environment at home. And the main thing that we've emphasized is over communicating. What was once, a monthly all hands meeting turned to be a weekly one, and what was a weekly team meeting went to a daily routine, because at least at the beginning we need to over communicate, and I think we've done well there. I'll just say that the interesting part is how to look at this lemon, how to make lemonade out of this lemon, and COVID. Is probably the greatest accelerator of digital transformation. We're working with a lot of banks, for example, and we've seen one of our closest partners, he had a 3-year program of moving their call centers to the cloud. It was a big project for the bank, planned gradually for 3 years' time, and they accomplished this in 3 months' time, starting to boost it at about April or May. And that just caused them to create a task force evaluating what other what other programs in the organization they can speed up, because COVID actually proved to them that that things can be actually done much faster. And the last thing I'll say, maybe, that as you see in, I think we're talking about AI later in the conference. So AI, a lot of the time for enterprises, is utilized to create better, visibility, predictability, and optimization of the business. And in COVID, where there's a lot of uncertainty and everybody's working remotely, it can even bring a greater value. So there was momentum to be captured at each of the portfolio companies, just as an example, to look at where those opportunities are to grow the business. I'll just give an example. One company of ours called Setzel is leveraging AI in order to identify winning sales behaviors of sales reps. That in customers that sell to other organizations, and then based on identifying those sales behaviors, incentivizing the sales reps to work on the right deals and to do the right things that will lead to secure more business, and now managing the sales force for someone that leads 1,000 salespeople is much harder than before. So seeing how this kind of technology that was great beforehand, all of a sudden its business started accelerating, it was securing 7-digit deals, because it's much harder to do so. So in AI specifically, which we'll talk later on in the conference today, it's one example of a lot of opportunities being made because of the pandemic.
I can repeat the previous speaker saying that first, every company got very fast into the new situations. This is not surprise. We are high-tech, smart guys, working from the office, working at home. Was really very, the transition was very smooth. What really surprised me, in February, March, when we began the whole process, we were concerned. We were concerned that it's going to be very difficult to raise money. When you have a portfolio of 18 companies, Grove 1 plus Grove 2, this is a concern. There's always few companies that are planning to raise money. What the message from us, from the fund to the portfolio companies was, let's recheck our situation and see who is planning to, or who needs to raise money the coming year. And we were pushing our companies to go and to raise earlier than planned. And surprisingly, that's a surprise, there was no issue of raising money. Money is there. Money is looking actually for great companies, and even more than before, because I do believe that many investors understand that keeping money at the stock market, it's very fluid, and every day it may just crash. Keeping money as a cash is very problematic, and people or investors were more ready for taking the long-term investment, understanding that this would create for them great success, even if it takes the time required in investments in high-tech.
Sounds like Dov, Liran, and I all had the same amount of humility around our predictions for how tough it was going to be in March. I got COVID really early on. I remember having a conversation I was really sick. I had a conversation. We had a Zoom with 20 something of our CEOs, and we told them to be really careful. And then we had 3 companies in particular that had big rounds, had term sheets out for big rounds. A cyber company called Inperson, a company called Scream, which is a big data company, and Identify, which is genetics, healthcare software company, and all with an Israeli component actually. But they all raised big rounds. Between the 3 of them, they raised around $100 million. While I was sick as a dog, and I just wouldn't have expected that. It sounds like Ron and Dov wouldn't have expected it either, and we were all pleasantly surprised. But I think that's really important to say. Things are different. So I think about how companies sell all the time, because when you're, especially for the enterprise companies, and sometimes it's not that easy if you're an enterprise company to set up a meeting with Walmart to try to sell $1 million software SaaS package or something like that. And it may take 3 weeks to a month just to set that up. The positive thing now is that you can do that on Zoom. So it's a little bit easier once you get the introduction and there's some interest to set up that first meeting. Whether small companies can close really big deals in the same way that big public companies can without a face-to-face, I think that's playing out. I think that still might take some time. But from the initial sales cycle perspective, in some ways, things are a little bit quicker. I worry on the flip side, again, that the trade shows and all the stuff that like Danny and DC Finance often does, our companies do the same thing. And if they're not out there doing that now, they have to get very creative and move some of their marketing online. And I've been really impressed by how innovative companies are. But that's going to play out over the course of the next 6 months to a year. So far, so good. But we'll see.
You each touched on fundraising, so maybe it's worthwhile diving a little more deeply into that. What have your perspectives been on companies raising money? But 2 things. One, what has your perspective been on companies raising money? And then for those of you who are, running funds and bringing in outside investors, what has your perspective been on bringing in capital to make those investments? And I think it'd also be interesting, we've talked a lot from a private company standpoint, which should still be our focus, but if anyone has any public company thoughts on that as well. So sort of fundraising, how to bring in investors, and private versus public.
I'll just say that statistically, for us, it's at least we were fundraising during the pandemic, and initially it was scary fundraising for the fund. From LP investors, and surprisingly, that funding atmosphere was working well and not impacted by the pandemic, and even more so, apparently. The vintage years of funds that started into a crisis or at the end of the crisis were statistically the greatest funds because the pandemic creates a lot of opportunities. And from a funding standpoint or from an investing opportunity standpoint, fundraising for startups, based on exactly what we touched upon earlier, since we manage the risk and assume we need to slow down the pace unless we can fundraise, you see startup companies going out for fundraising earlier than planned. They had enough capital to build more value and raise in a year's time or what have you. But because they don't want to slow down, they actually attempt to fundraise first. So we actually see from a deal flow standpoint, a lot of great companies, great opportunities with great traction that we can partner with them early on because of that. So very active on the fundraising for the funds and also very active on investing in startups and the deal flow on our end.
Well, we were in a strange situation. We actually finalized our fundraising for Growth 2 in December 2019, by the way, with the help of DC Finance. And we said we're going to cut it 120 exactly. We want to raise more than that. Finally, one of our previous investors came and said, you must take our money. It's 123. But began the pandemic, and we got actually a flow of of entities or investors saying, hey, can you maybe grow the fund, make it larger? And we said, no, we don't. We said 120. By the way, I said, everybody 120, I'll cut 120. We went to 123 because this was really very, very good. Investors, he gave us the okay. It took the time for him to get approvals. Okay, 123. But we didn't jump we didn't grow. So we did see a great situation of money that is looking for targets. That's a phenomenon.
Yeah,
I think it's going to be. I think there's going to be a little bit of a bifurcation of the market, and there already has been a little bit of a bifurcation in the market. I think when those three companies that I mentioned were financed, they're all sort of enterprise companies. I think things got a little bit more difficult for the more risky consumer companies, and maybe that's changed and it's leveled out. But enterprise companies, because they could help people adapt to the cloud more quickly and use technology more quickly, I think that the market realized they were generally well positioned. I also think that consumer behavior probably changed a lot more than enterprise behavior. So that's obvious. I would also point out that the stock market always, especially if you start, these companies have to start raising money from somewhere, so you start with angels. And I think that the stock market has been quite good. And that always has an effect, in every regard, not just at the angel financings, but also through venture financings. If you look what's going on in the SPAC world and how crazy that has gotten, that's another source of liquidity that generally didn't exist a few years ago. So if you have some more exits and you have a good stock market, generally, I think that is really helpful for the venture market generally.
I'm happy to share some insights as a company that's fundraising. So we were in a really interesting situation. We closed our round right at the end of 2019, our last round at the end of 2019. So when the pandemic hit and March and people were sort of at the peak of uncertainty, we were actually in a pretty strong capital position because we had just raised and had barely even started really deploying that capital. We obviously weren't in the market at that time. What started to happen, especially as we were growing so quickly, was that we were starting to see so much inbound interest from funds saying, hey, you're in a vertical in education that predominantly had been overlooked in a lot of cases and now is hot. A lot of people were starting to warm up to it. And it was really interesting. And Dov, you made this point earlier. I think it's really, really true too, that given so much volatility just globally in terms of what's going on, it's a great time to be backing early stage businesses because they're the most agile and the ones that can adapt as quickly as possible. And I think that's what we were starting to see, was that the market was waking up to the fact that, like, wait a second, if you have a really big TAM, if there's a market that you can address in your early stage and that market is evolving fast, you want to get into the earliest businesses you can there, because the legacy players aren't going to be able to move fast enough. So all that to say, we've seen a ton of interest. Our board at the beginning was like, look, we need to plan for the 24 months, maybe even 36 months of no capital being available and so on. And my perspective as the operator, as the CEO, was like, look, I think the best way for us to fundraise, if we're uncertain, is to go to our customers, right? Like have revenues driving the business. And so we really focused on that, and then we started to see revenue grow. But it was interesting. I mean, in the end, I don't think there was much. I don't think that things slowed down at all. And we have a number of data points that indicated that. Some areas obviously impacted quite heavily, but I still think in those areas there's so much opportunity. Where travel and hospitality, the market may be slowing right now. Are we going to be back on planes in a few years? Absolutely, right? So you may have some real opportunities there for some early stage companies that are really going to transform some of these huge markets. I think it's a great chance. And I second the fact that when the stock market is good, angels are looking to deploy. Everybody's an investor, right? Everybody's a genius. I think that plays well as well into the fundraising for funds, if you're looking to seek out some LPs, but also for companies like Paper, you're talking about, bringing in perhaps some angels or strategic investors. They're going to be a lot more comfortable making a venture type investment at the Series A or Series B stage than they would have been maybe 2 or 3 years ago. So all that to say, we had anticipated a slowdown, did not see it, and in fact, in our particular case, we've just seen things accelerate. We're fundraising a year earlier than anticipated because the markets are good, and we can deploy that capital in a really impactful way.
And it's sort of a side note to this question, but are you all sourcing investors differently? I mean, Dov talked about looking people in the eye and being in a room with them. I mean, that's been our experience as well. Typically, to close a deal, there's always at least one meeting in person. And on the acquisition side, on the investment side, we're seeing that people aren't doing that. Are you guys finding novel ways to source deals or to meet with people?
We meet over the Zoom, of course, but I'm working at the office in the last 4 or 5 months, and clearly we are, and yes, we meet we meet entrepreneurs. I think it's very difficult to invest without seeing eye to eye the entrepreneurs, to look at the team, to see the relation between the team members, and when the CEO says something, what the CTO how is he reacting? You can't do it over Zoom. This is totally impossible. So we do see companies. We do see them usually not at the first meeting. It's a second meeting or third meeting, and we do investments, but they will always happen after we will meet the team clearly.
I've discovered the habit of doing meetings over walking nearby the beach. This is something I've never done before. It's actually a new tradition that I'm doing now, which is actually proving itself very worthwhile.
I definitely look forward to getting to Israel so I can meet Liran in person and take a walk on the beach. That sounds lovely.
It's a date.
I think we had a little bit of a, we're doing the same thing. We're sitting outside in New York with companies or having them in a really careful way. Our office is not as busy as it was. We got a big building here and lots of space to use, so thanks to our partners at Silverstein. But, if we're going to be honest, there was definitely, in this late spring, there was a slowdown in meeting new companies, for us anyway. We've done some other panels and other guys have said, yeah, we never slowed down in meeting new companies. We didn't stop, but we definitely slowed down. And I think it's picked up and it's back to normal now.
On our end, so we've grown our team almost 3x. And so I'm thinking about this.
Hired a lot of people.
Hiring. And we recently recruited a top tier CMO, through a recruiter. And first thing they said to us, they said, and we started this process in like April, right? So it was like, we had no idea how long, if we were ever going to meet the person. And the first thing they said to us was like, listen, I need to know, you got to be honest with us. Are you comfortable hiring this person without ever meeting them? I said, I'm running a business here. I don't have the opportunity to wait and see how things play out. We're going to have to get comfortable with this pretty quickly. And, we did. We've hired a ton of people through that. And, now we're going through the fundraising process. Fortunately for us, we've met a lot of the funds we're talking to in person. So you do have that relationship. I agree with you, Doug, 100%. You want to look the person in the eye. You got to sort of like feel it out a little bit. But we had this conversation too internally. We're like, listen, we're going to have to make this decision to take capital from somebody we've never sat down and broken bread with. And that's going to be something that's new for us. But, this is the world that we're in today, and the business is growing so fast that I don't want to sidetrack a deal because, I can't fly across the continent to, the Bay Area to have that meeting. So I'll also say too, maybe it gives an opportunity to some more local funds to throw their hat in the ring as well. If they can go for those beach walks, maybe that's an unfair advantage in those cases. So we'll see. But I think, you really have to be able to adapt to that. We have, and I guess the results are still out, the jury's out on that, but we really had to make that move quickly. And I think it's just a philosophical thing too, right? It's like, hey, we got to you're going to do this or you're not. And, don't look back, right? Make that decision, right? So anyway, that's where we're at.
Adam, do you mind if I ask a follow-up of Philip?
Please.
Yeah, so Philip, I'm kind of, first of all, thank you for anyone who has kids home part of the time, thank you for taking care of them. We really appreciate that and teaching them when in the gaps. It sounds like your mission is, super important for people in my demographic anyway. But fundraising for an entrepreneur is never what they like doing, because they like, developing product and selling product. And it's always a distraction. And there's some positive aspects to it from a network perspective and from honing the business perspective. But come on, you really want to be out talking to customers and in the product. So did you find that not having to fly around the continent has been like a time saver, and it's been a convenient excuse to sort of set up meetings more quickly? Or has that sort of been a wash?
Yeah, absolutely. Like we did 12 meetings in a day last week. So, I mean, that's impossible, right? Like in the past, and this is, a mix of New York City funds, Bay Area funds, LA, Chicago, some in Canada, like we would never have been able to do that. The velocity at which we can have those meetings is incredible. And I think the big shift that we've seen, and this is true on a number of fronts, we talked about the hiring side, but also for our customers and the fundraising, is there's a broader acceptance to having these type of Zoom conversations, as a first or second meeting, and no one's really concerned about it. And we've just seen like general comfort with, getting to know somebody virtually. I don't think it fully replaces it, but people have come to terms with it. And so it saved us a ton of time and money. I mean, me personally, just not having to be on a plane, I usually take anywhere between 80 and 100 flights a year. This year, I checked my status, I've taken 3. So that's a ton of time, in airplanes, airports. So
maybe we get to a spot where we can do the first 3 meetings instead of just the first one online, save a bunch of time and a bunch of travel, and then be able, as Dov said and Liron said, to look someone in the eye or take a walk with them at the end. Maybe that makes business more efficient, generally. And I think that's the message that all of us are really conveying, that for the types of companies that we're involved with, there are a lot of efficiencies to operating right now. And when I say that, I don't want to be callous to the severe pain that people in the, especially in-person services industry, globally are really facing right now through no fault of their own. I think we all should be, and probably are, really sensitive to being on the have side of the have not divide. And that's something that we all have a responsibility to address too.
Yeah. I'm trying to figure out what the equivalent of a walk on the beach would be in Montreal in the winter. It's the opportunities are maybe not the same.
Some advantages in Israel.
Go take a walk in the underground metro, and I don't know.
At least the mask is helpful.
I would say that we've been wearing masks in the winter for years, right? No behavior change there.
The other thing, Adam, with tech companies is a lot of them have had distributed technology development. We have 3 companies that in New York that have had tech development up in Montreal, actually, and then a whole bunch that have had development in Israel and throughout Eastern Europe and Asia. So they're sort of used to it.
They've seen it already, right?
Yeah. And there's a lot of developer tools specifically for distributed teams that you can implement, right? So I think those companies have also seen a pretty big spike, which I think is positive. But you're spot on.
So One of the interesting, when the panel had spoken before, one of the interesting questions I think that came out of it is, what are we going to be talking about in the next 10 years, 20 years, and 30 years from now? What are some of the transformational trends, other than the things we've already talked about, but what do you think the next big things coming down the pipe are, and what are going to be the big topics of conversation, excluding the US election?
I'm not sure. No, I know what I'm going to eat for dinner tonight, so definitely don't know about 20 years from now. I'll chime in first. Maybe I'm a cyber guy, so I'm biased towards focusing on managing risks and all sorts of things. So some things I hope we deal with is, latency problems with connectivity to Mars. If some of the space tech initiatives and Elon Musk's dreams come true. Dov likes this one. Or robots that will misbehave, assuming that a lot of robotics and AI will help us with a lot of our daily business and personal lives, and therefore explainability and troubleshooting of AI will be key at around 2050, I hope. We'll see we'll deal with micro drones that keep peeing into our showers and things of that sort. In health, I hope we won't be living in a world that is designed for pandemics and capsules for social distancing for the longer term. I think we all hope for that there won't be another pandemic and then another one. And I hope we'll see a world where, data science will get us to even, digital drugs or things of that sort. And now relating to things that I really know something about and not to things that I'm just guesstimating and throwing out there. I think advancements in data science, but also in security and encryption, will allow us to be much more efficient in how we collaborate on sensitive data, which is most importantly in healthcare. So the ability to actually work on things like genome data and the DNA sequences of all of us that you cannot anonymize, or you can anonymize and still, even without my name or my ID number, the DNA sequence, you can reverse engineer it back to me and you can replicate me someday with it. I'm hoping to see more and more innovation that will allow us to cure cancer faster, to have healthcare providers collaborate with pharma companies to do clinical trials without hurting users' privacy. And generally at 2050, I believe we'll see the advancements of a world where users, or all of us as consumers, as the end consumers, will have much more control of our data, what it is really being utilized for, and having the ability to understand what's the purpose for it and how to control it for a much more, a world with much more digital trust than we have today.
I've no doubt that this COVID-19 is giving amazing push toward the issues that relate to digital health. If you look at the current hospitals system, terrible. I can talk an hour about what's bad about the hospital system, but anybody that has been to a hospital doesn't need this speech. The whole pharma industry, the whole issue of lack of data, that you see it amazingly at the handling of this COVID-19. So a question which I ask is 30 years, are we going to see COVID-27? And yeah, there'll be COVID-27, but when it will happen, maybe 30 years from now, maybe 20 years from now, each one of us is going to carry a sensor. Each such sensor will transfer data to the big, huge clouds, and all this data will be gathered and analyzed real time. And when the new COVID-27 will jump out in a village in let's say Malaysia, then and then somebody will catch it, and then he will make 2 others to have it, and then 8 or 16. The system, the world system, the WHO system, will figure out that there is a new pandemic, and they will understand and they know exactly where it is, what's the phenomena, and they will be able to isolate it in a way that actually in a very short time this will be handled locally and won't reach other parts of the world. So I do believe that all the issue of digital health are going to grow. Everything that relates to artificial intelligence, new kind of pharma, a lot of DNA-related information and concepts, and practically much better work.
Well, okay, I'm not gonna be quite as bold as to predict out to 2050, but let me talk about something that I think everyone is thinking about. We've spent the last hour telling you how wonderfully many of our companies have adapted, how we've adapted, and even though we may not love it, I think that people are craving in-person interaction. And I think that there's a lot of serendipity involved in life and in friendships and in business. Specifically with respect to business, I think that you make some connections that you don't always expect when you're around other smart people, interesting people. And I think we're going to go back to that. I'm not saying that everyone has to commute an hour every day forever. I think that maybe we'll gain some more time a few days a week, and we'll realize that in-person interactions in an office or somewhere like an office are super valuable. I can't tell you how many companies have been in our office and met the CTO or the CIO or the CISO of some major company and ended up in a sales cycle and ended up with a sale. And they wouldn't have done that if they didn't get out of bed and show up in the morning. So again, I'm not sure it has to be every day. I think we're going to move to a hybrid type environment, and different people are going to be in different roles. But for people that are out selling and doing business development and raising capital and doing all the stuff that many of the people on this call do, in person is really critical. And I think people crave it, and we'll get back to it in some meaningful way.
Yeah, I feel like I have to say something here, but I'm not. I think it's tough. The one thing I'll say is this, and I've thought about this quite a bit. I think a lot of the innovations that we've seen over the last decade have really been the foundations to much larger, more broad innovations. I'll give you a couple examples that come to mind. So, electric vehicles and like self-driving capability, right? That to me is something that like it's just going to completely evolve, right? We're at the very early stages of how that's going to actually look. And I think the speed at which it's evolving is happening really quickly. I think like things like voice assistant technology, the way that, I mentioned, ordering food from somewhere and then I'm on Instagram getting ads for it, right? Like my phone's listening to everything. Like I think there's a lot that's built in there. That's just so much. It's in its infancy to a point that we can't even really comprehend what's going to happen in the future. It's going to happen so quickly that it's really going to be, it's going to be crazy to see. So some of those areas that like we've seen the early traction, I think it's like it's still in the first inning, and that's going to drive a lot of the big innovation. Sort of the way that they introduced PCs and computers 20, 30 years ago, and people were like, oh, this is kind of cool, whatever. Like we didn't realize the capability that we're going to be carrying one of these things with us that's 1 billion times more powerful than what the most powerful computer was like 5 years ago. So all that to say, I think that we're going to see some pretty quick evolution in some of those markets.
Great. Look, I think we're down to only a minute or two left. We do have one question that maybe you can touch on very quickly, which is about your thoughts on sustainability development goals and environmental, social, and governance. I guess, Danny, you can cut us off when we're out of time, but does anyone have any thoughts? That was one of the questions that came in from the audience.
I think ESG is going to be a bigger deal, especially for bigger companies. I think they have to find ways to quantify it. And there's probably some pretty smart software companies that are going to figure that out. But I think that it's probably going to be driven from the biggest companies and filled in by solutions from the companies that we would work with. Huge area, very important.
Thank you. I appreciate everybody here. I just want to say to Philip, you mentioned that the travel industry is suffering and some of them are reinventing themselves. I think that you just hang on in there because we're coming back big time. I don't know if it's a thing of only a guy like me with 5 kids, but I'm planning travel to destinations I don't even work at. I have 3 trips already for Ghana. So I think all of you that tell me that, oh, it's so amazing to work at home and we have such a ball and beautiful life is shining on us, I'll give you another month or 2, and then I'll see all of you with kids starting to make your travel plans like crazy. Okay, so with all due respect to everybody here. So thank you everybody for an exciting panel. And see you guys next week at our US conference, not so far. We might even know who's the president, who knows, crazy. So thank you so much, Adam, and everybody.
Thanks, Adam.
Thank you.
Thanks, Adam.
Thank you, guys. Thank you, everybody. So I'm excited to have our next speaker to talk about what's going on right now in the financial world, alternative fixed income, the benefits of a diversified and well-implemented program. So in a second, we will have Philip, where am I? Paul Sandhu, who's the president and CEO of Marret Asset Management. I see him here. He will join us in just 1 second. And here you are. Good morning. How are? Well, actually, it's not morning anymore. Good afternoon. How are you?
I'm well. How are you?
Great, Paul. Where are you?
Also have Denny. You actually have 2 of us. You have Mark Culver too. So.
Oh, and Mark Culver. Sorry, I'm looking at the agenda online here. Hey, so
no
where are you guys this afternoon?
I'm in Montreal, and Paul is in Toronto.
Got it. Great. 2 of our destinations. So I'll let you take it from here and talk about the benefits of our diversified and well-implemented program.
Okay, great. Well, thank you, Denny. And it's great. We appreciate being here. We have a pretty packed 20 minutes here, so we'll move things along. So just when we think of the environment that we're in, right? Well, first of all, I'm Mark Culver, Marret Private Wealth. I'm the president of Marret Private Wealth, which is the part of our business that that serves the private client business, our private client business. I'm going to talk for a couple of minutes and pass it over to Paul shortly thereafter. So when you think of what's going on in the environment, we know that we're faced with this great, maybe overused term like uncertainty and unprecedented, but maybe it's not too much of an exaggeration. It's when guys like Ray Dalio say it's like the 1930s. I guess none of us have been around to say if we're around that time. So for sure, we're dealing with situations we've never dealt with before. But we do know that over the last 40 years, interest rates have gone more or less continuously down to the point where, to get any kind of income or yield right now, it's very, very difficult. And so our view is that to address the situation, you want to have an effective fixed income program that gives you your best route towards income and total return, while also preserving capital protection and sort of negative or low correlation aspects traditionally associated with fixed income. So I'm going to just talk a little briefly about our team right now. We have, when you think of Marret, you think of 21 people from very different ages and backgrounds that all come together with a common mission of achieving the best risk-adjusted returns in fixed income over the long term. And to do that, we've got a program of strategies that address the full credit and duration spectrum. Has everybody seen our screen right now? Denny, do you see? Okay. Yeah, we can see it. Okay, so on to the 3rd slide here. This is a mandates we're going to talk about today that are particularly interesting, I think, for the private client market. Starting on the lower left of our risk return graph there, we have our strategy we call Marret Enhanced Tactical Fixed Income, which is a low duration cash alternative mandate with an objective of earning 200 basis points or more over cash options, traditional cash options. options. And moving up in the middle, we've got Marret Investment Grade Hedge Strategies, which is a fund that Paul runs directly, long short credit fund that that is an alternative to traditional corporate bond portfolios, lower volatility and really low or no exposure to rising interest rates. And that's a fund that's run with a lot lower leverage than a lot of other kind of alternative credit strategies that people in the audience may be familiar with. And then on the far right, we've got our newer strategy, which is our most unconstrained mandate Marret Debt Opportunities Fund. It really can access all of the fixed income sectors and in an unconstrained way with a full toolkit. And then at the bottom here, we're kind of bragging about the award, well, showing the awards that we won a couple of weeks ago for these three mandates. The Marret Debt Opportunities Fund had the best one-year return for the Canadian Hedge Fund Awards, and the Marret Enhanced Tactical Fixed Income got the first place for Sharpe ratio, third in 3 years and 5 years, and the Investment Grade Fund for third place for 3 years and 5 years Sharpe ratio. So I'm going to pass it over to Paul. Paul is going to speak more detail about our process and how he sees the challenges of facing investors right now, as well as a bit on the outlook. So pass it over to you, Paul.
Great. Well, thanks, Mark, and thanks everyone for joining us. I'm Paul Sandhu. I'm CEO and CIO of Marret Asset Management. I'm going to focus my remarks on three areas. One is just to give you a kind of a quick review on our investment process at Marret. Number two, I'm going to talk about the challenges investors faced in fixed income markets these days. And what I'll do is I'll conclude with our outlook, and I'll give you sort of our global macro outlook, the outlook for fixed income, and then I will also talk about some of the risks to our outlook and how we could be wrong, or what could go wrong. So let me start with the first, the investment process. As Mark has alluded to, Marret is a specialty fixed income manager. We focus on corporate credit across the rating spectrum, so everything from investment grade to high yield. And although we focus on corporate credit, and we have a lot of resources dedicated to kind of bottom-up analysis, our mandates don't have to be invested in credit. They're flexible, and they can be certainly 100% exposed to credit, but they can also be exposed 100% to governments or to cash. And the reason for that is that, in our view, fixed income is not a static asset class. And in your presentation, there's kind of a grid that you'll see that kind of just shows how different parts of fixed income perform at different parts of the cycle. And so because we think that fixed income is not a static asset class, and different parts perform differently depending on where we are in the economic cycle, the interest rate cycle, and credit cycles, our mandates are very flexible to be able to reflect that. And that's why our investment process is so dedicated to understanding the global macro environment and the global macro outlook, along with valuations, which are always important in any asset class. That understanding of where we are in the global macro environment and what our outlook is provides us the ability to kind of be tactical and position our funds in the segments of fixed income that will produce the best risk-adjusted return. And I think that's really what kind of distinguishes Marret from other fixed income managers, and certainly other fixed income credit managers. We don't stay in the asset class that we're obviously we have a great deal of understanding about, and is really kind of the roots of our firm. We do understand that the economic environment changes, and that fixed income will have different types of returns depending on what that backdrop is. And I think 2020, if you just think about this past year, it's a perfect example. At the beginning of this year, it was best to be in high quality duration, right? That was up until March, and then and the reason for high quality and duration was obviously we had a big sell-off in March. Central banks moved to cut rates effectively to zero pretty much everywhere in the world, and certainly in the industrialized world. And that aspect of having duration and it being in high quality produced obviously the best returns during that period. But then when we had to draw down, the idea was to pivot into high yield and investment grade credit. And in this final part of the year, it's best to kind of be positioned for increasing volatility. We expected that with the US election, Brexit, vaccine, no vaccine, second wave, all that sort of stuff, that we were going to start getting more volatility. And as a result of that, you wanted to have some cash to be able to take advantage of that volatility to generate alpha. So let me move on to just what I'm thinking about fixed income and what challenges I think investors face. And I think there are really two big ones. One is, what do you do with cash? Because obviously the bank isn't paying you much. GICs are, like a 5-year GIC, I think, is under 1% now. And so what do you do with cash, and what do you do with fixed income when yields are so low? And I think at Marret, we have two really good solutions for that. And Mark showed you a few of our mandates. We have a number of award-winning mandates this year and over the past years, but we have two solutions which I think really make sense for what to do with cash and what to do when yields are low. So the first one is really, in terms of what to do with cash, really focuses on our mandate, the Marret Enhanced Tactical Fund. That is the fund that was designed specifically to be an alternative to cash, and its objective is to try to get 3 to 4% return, year after year. And the idea there is to get that return, but also have incredibly low volatility, non-correlation or no correlation with anything else, and to ensure that you have maximum liquidity. So if you want your cash to take advantage of a drawdown or for some other need, you've got it available to you. At the same time, you're very uncorrelated to anything else. You have very low volatility, and you are getting an attractive yield, relative to cash. That fund, as Mark mentioned earlier, was awarded first place for 3 and 5 year Sharpe ratio in the recent Canadian Hedge Fund Awards. And to us, that idea of having superior performance from a Sharpe risk-adjusted return point of view is really valuable. We've proven that this strategy works. It has really low volatility. Obviously, has a great return relative to the amount of risk we're taking, and we've been able to do that over a long period of time. So that's really what we think is an attractive opportunity for where to put cash. We've been running this strategy for over 6 years. And certainly we're happy to, in Q&A, if anybody wants to know how we produce that return, we're happy to talk about it. In terms of fixed income more broadly, what do you do when yields are so low? And I guess our solution really here is to be in something that's a bit more tactical. And that's what the Marret Diversified Opportunities Fund does. It placed first in 1 year return this year. So it's had really great performance. It's a fund that's kind of unconstrained. And what we do is we tactically position that fund in each segment of fixed income that we think is going to produce the highest returns within the context of that macro outlook. Where are we in the economic cycle? Where are we in the interest rate cycle? And where are we in the credit cycle? And generally that fund is composed of the best ideas in all of our other funds. So whether that's our investment grade funds, our high yield funds, or our duration mandates, we take all those best ideas along with other ideas generated by our research staff to basically generate that return. It's very tactical and it is actively traded. And on page 9 of our presentation, you'll actually get a good idea of how we've actually moved this fund around. And it very much speaks to what I said earlier about what 2020 was. You can see how we were positioned at the end of 2019. We had a huge amount of cash and we had a lot of government duration. So we were in high quality. And then, of course, in March, following the very significant drawdown we had, just look at how the composition of the fund changed. It pivoted very much into credit, right? And then look what happened in terms of the government positioning. And you can't see it here, but you will see in the next chart. But that government positioning was also about not just reducing the government positioning, it was about reducing the duration as well. And then, of course, in the last segment of this chart, you'll see how we went into sort of the period of the US election. We've actually took profits on high yield. We took profits on investment grade. So we crystallized a reasonable amount of our return. We increased cash to take advantage of some volatility, and we've been certainly getting a lot of volatility over the last few weeks. We took, we increased cash to take advantage of that volatility. If you saw the fund today, you would know that we actually spent some of that cash and did take advantage of some of the vol, certainly in credit and in rates over the last two or three weeks. So let me move from there, having talked about those challenges, cash, and what do you do when the environment is low yield? I mean, cash, we have this great alternative in MET, and on the yield side, our general view is, listen, you need to move away in fixed income, away from sort of passive yield type strategies, and think about total return and active total return, which is why the Marret Diversified Opportunities Fund makes so much sense, because it is very tactical in terms of where it's positioned in fixed income, and it is very active. So let me move now to our outlook, and first of all, sort of the macro outlook. Obviously, we've had a fairly impressive, V-shaped recovery in financial markets, and in some ways in the global economy as well. But in our view, the return to pre-COVID economic growth is going to be long and quite frankly painful. And by the way, I think it's important to understand, because I think we've forgotten about this, that the pre-pandemic growth outlook wasn't exactly that robust. We've been basically in a kind of a 3% global growth period for an extended period of time. So it's not that we had fantastic growth before COVID came along. We actually had pretty muted growth. But the pandemic unfortunately has is going to leave us with some long-term structural damage to the economy. So output gaps are going to remain large, and that's just not me saying that. If you go and look at the outlooks for almost every industrialized country central bank, they're essentially, you can see in the data and their forecasts that most of them are not expecting us to return back to pre-COVID levels until 2023. And that's because, the output gap is going to be a lot larger. We've obviously have a high level of unemployment. We've obviously had, unfortunately, some insolvencies, and we're probably going to have some more. And those have created an output gap that is going to persist. So it's going to take the economy a long time after this initial recovery to get back to that level. And the initial recovery, you have to be kind of reflective of it. If you close everything down and then you open it back up, obviously you're going to get a V-shaped recovery. But that's all we've gotten. The structural damage, the longer-term structural damage, is going to take some time to get over. And in our view, and by the way, Marret was saying this last year. So at the end of last year, we were saying that we are about to enter a period. Now, we didn't predict there was going to be a global health pandemic, but we were about to enter a period of low growth, low yields, and low inflation. And that is our long-term characterization of the economic environment. And I'm not trying to depress everybody, but frankly, COVID isn't going to change that. Even the response from central banks and even the response on the fiscal side from governments is not going to change the fact that we are on this low growth, low yield, low inflation environment for a long extended period of time. And the reason for that is that those drivers, what drives economic growth? Economic growth is driven by credit creation, population growth, and productivity. Each one of those face enormous headwinds. And you'll see, later on in our chart, if you want to go through our presentation, you'll actually see some charts on, where we are, where we are in credit. The world is more indebted now than it has ever been in history. So global debt to GDP is 330%. It's actually higher than it was at the end of 2019, and that it was high then. And we were warning our clients then about this. So we've had to take on greater debt, and governments in particular have, through fiscal stimulus, added massive amounts of debt. So the drivers of growth, credit creation, and population growth has been falling for 40 years, and it's not expected to get better. And productivity also is being lower. And by the way, for those of you who follow productivity, you'll know that productivity goes in really long cycles. It is not a cyclical phenomenon. And we are at the low end of a cycle, and it is unlikely that we are going to get higher productivity anytime soon in the next couple of years. And in fact, there are now, because of COVID and because of trade friction, some inhibitors to productivity. If you basically have deglobalization, that's not good for productivity. If the uncertain economic environment, basically retracts companies, business investment, that is not good for productivity. So our general view is this low growth, low yield, low inflation environment is going to persist. So it's important to understand the investment environment you're in and then say, okay, how are we going to profit from that? And in our view, what is happening here and what you have to understand, we're in that environment and how are we going to get out of it? And in our view, what is happening is that governments and central banks are trying to orchestrate what we refer to as the beautiful deleveraging. And in my own view, I think the beautiful deleveraging is going to take a better part of a decade. In other words, you have to get all that debt that we showed you in that chart. You actually have to get debt lower so that you can then create another cycle of credit that actually is additive to global economic growth. So this beautiful deleveraging, it really is focused on 4 specific parts. What are governments and central banks trying to do? Well, we have to keep government bond yields low because we have to try to provide relief for the huge amount of interest burden that individuals, companies, and governments now have because of this huge amount of debt and huge amount of leverage we have. Central banks, number 2 in that is, in this kind of beautiful deleveraging scenario, is that and central banks have to create the impression of that inflation is going to be positive. So that's why you've seen a number of central banks, including, by the way, the Bank of Canada, in our view, essentially abandon the reaction function. Central banks, basically have one reaction function, which is they're supposed to focus on inflation. And so they've almost more or less, in our view, abandoned that because they're now saying, hey, we don't care if inflation actually goes above 2%. We want people to think that inflation expectations are going higher. Obviously, a deflationary environment with a huge amount of leverage would be incredibly negative. Number 3, the focus has to be to increase employment because you want incomes to rise. That's why fiscal stimulus has been so important. And that's also why central banks have basically modified their reaction function away from inflation, in our view, to employment. And then finally, you need to maintain the flow of credit. And that's, in our view, if you want to maintain the flow of credit, you have to have continuous QE. So in other words, central bank balance sheets have to be bloated for a very long period of time in order to kind of create this beautiful deleveraging scenario so that at some point we can have a more prosperous economic environment that creates a credit cycle, which is really the important factor behind creating a longer term period of economic growth.
Thank you. If you have just one more word to add, because we really have to go to the next session.
Okay.
So
I just want to, I think the final word I would just say is this. In fixed income, you have to realize, all right, if that's the environment you're in, what parts of fixed income are going to have volatility, what we call the opportunity set. And if you recognize what the opportunity set is, and we look at this in our presentation a bit and then comment on it, then you have an understanding of where the vol is going to be and where you can create alpha for your clients to get that total return that we talked about.
Paul, thank you. I appreciate it. Paul and Mark, thank you so much for your comments. I would like to thank you for that, and we need to quickly move to our next session because online there are many benefits, but this is a disadvantage. We have to be right on time because people are just joining us on Zoom, and I am happy to invite Mark Minevich, which the way I would describe Mark is not reading his title, more like I think one of the biggest experts in AI that I have met in my many years of doing conferences. I think Mark is didn't just build an exciting panel you'll soon see with Kay and Sylvain, but also at our US conference, an amazing AI session with some of the top names in the AI world. Thank you. Take it away, Mark.
Thank you very much. I'm passing it on to our studio, Digital Pioneer Studio, with Angelina. Angelina, the floor is yours to introduce.
So much, Mark. I would like to welcome everyone to Digital Pioneers Network discussion, which is proud to do a technology AI panel as part of DC Finance Canada Family Office event. As you already know, DC Finance is an international network of high net worth individuals, family offices, and investors supporting over 2,000 families who represent over $500 billion of assets, as well as the largest institutional investors who manage $1 trillion worth of assets. Our own Digital Pioneers Network is a digital transformation media platform and think tank of leading artificial intelligence, thought leaders, innovators, policymakers, entrepreneurs, and world-renowned experts such as Mark. The contributors of these individuals plays a critical role in acceleration of global digital transformation, the reinvention of digital economy, and evolution of humanity. The Digital Pioneers Network is collaborating with media production European group Telegraph, from where I'm currently tuning in from, as you can see. And today we have an intimate panel with great leaders and experts discussing AI, ethics, and social impact investing, such as Firth-Butterfield, head of AI and machine learning, and a member of the executive committee of the World Economic Forum. In the UK, she is a barrister and a part-time judge who has worked as a mediator, arbitrator, business owner, and professor. In the United States, on the other hand, she has been a professor of law and international relations and co-founder of AI Global. Another fascinating fact from her biography is that she was the world's first chief AI ethics officer in 2014 and has created the AI ethics Twitter hashtag. So there you go. We will learn more about her, and also we will have the honor of welcoming Sylvain Duranton, who is the managing director and senior partner of Boston Consulting Group and global leader of BCG, which is a business unit dedicated to data science and advanced analytics applied to business. He advocates for a human plus AI approach, using AI systems alongside humans, not instead of them, and shares the specific formula companies can adopt to successfully employ AI while keeping humans in the loop. We'll learn more about Kay and Sylvain in an ongoing discussion with Mark, who will open up this dialogue. So I would like to share more about him as well, and to learn more from his rich experience and his biography. Mark is an executive chairman and co-founder of Digital Pioneers Network. Minevich is highly regarded and trusted digital cognitive strategist, artificial intelligence expert, venture capitalist, and the principal founder and president of Going Global Ventures. Mark was also recently appointed as a chair of AI policy at the International Research Center of AI under the auspices of UNESCO. Mark collaborates and advises large global enterprises, both in the US and Japan currently. He serves as the strategic advisor and global ambassador to the CEO and chairman of New York-based IPsoft Inc., and advisor to the BCG. Mark holds the role of senior fellow as a part of US Council of Competitiveness in Washington, DC, and he's appointed member of G20 B20's Digital Task Force. He also serves as the CTO and strategy executive at IBM. Apart from all this, Mark contributes to a number of publications, including Forbes, Entrepreneur, Observer, TechCrunch, Informer's Week, CEO Magazine, and he has been cited and featured in articles and appeared in Newsweek Inc., CIO Magazine, Hitachi Review, Japan, Telegraph UK, CNBC, you name it. Forbes named Mark as one of the leaders to watch in 2017. He has received the Albert Einstein Award for Outstanding Achievements and the World Trade Leadership Award for the World Trade Centers and World Trade Centers Association. With all this said, I would like to pass my mic to Mark, so he will open up this dialogue. Thank you.
Thank you very much, Angelina. With all of this, I feel like I don't know how many years I have under my belt, but it's really, truly an honor. Thank you, Angelina. Thank you, Danny, and this exciting organization that you had advising and guiding some of the leaders in the financial community, especially family offices. And we're excited, Digital Pioneers Network, as Angelina mentioned, to partner with you on this session. And I'm glad to have such incredible leaders here today, Dr. Butterfield and Sylvain Duranton, that are going to talk about today about issues that really matter to all of you, all the family offices, all of the investors, pension funds, and endowments in the great country of Canada, which is all about social innovation, responsible AI. Canadians have been innovating and really been guiding the effort on research and deep neural networks, and all this great work that is coming out of University of Montreal, Toronto, and others is, I'm sure, is reflected in all of your investments and everywhere else. So we're glad to kick this off. I have a first question to Dr. K regarding frameworks that Dr. K is seeing at the World Economic Forum, not only seeing, but also guiding and governing. And I'm happy to be part of the council that Dr. K. Butterfield is heading. And the question is, what are some of the most effective frameworks in place today to promote responsible AI. I know World Economic Forum is working on corporate responsible AI toolkits, which are very needed for the CEOs and the boards. Can you tell us a little bit about some of those frameworks? What is missing and what is World Economic Forum working on to improve them? And what do you feel responsible AI brings to the world of investors and business owners? The floor is yours.
Thank you. And thank you very much to everyone for inviting me to join you today. So going straight to the question, because I know we don't have very much time, frameworks. We have seen that a lot of the AI companies of the world have struggled with the balance between making money and the ethical implications of artificial intelligence. And when I started thinking about AI and ethics back in, I suppose, 2010, there were very few of us. And so I was the first chief AI ethics officer, and that was in 2014. And at that stage, I don't think it was necessary or it didn't seem that anybody else thought it was necessary for companies to really think about responsible AI, ethical AI, whatever you want to call it. But now that's not true. We are seeing CEOs in front of governments giving evidence. We are seeing in Europe a move to regulate various uses of artificial intelligence. And I think in January, we'll see that they do put forward regulations specifically around facial recognition and the use of AI in human resources. And so if you're thinking about companies, if they're using AI in human resources, then you need to be thinking about having a framework. How are you using that artificial intelligence tool? Is it ethical use? Or are you actually creating bias as you're using that tool? And you might think, well, why would I worry? Well, I think one, you worry because the regulators are really thinking about this around the world. Two, I think you worry because the developers are worrying about this as well. So I was on a panel the other day, last week, where I was advising the House of Representatives in the US about these issues. And there was a professor from the University of Toronto who was saying, you know, one of the reasons that we are not seeing a lot of new things coming out of Canada is really because we are worried about these ethical challenges of AI. And so when you're thinking as a business about ethical or responsible AI, I would say just think of AI as a potential problem for you that you have to solve. So you want to use all the benefits, but you don't want the problems coming out. So going back to that issue about human resources, you want to make sure that the algorithm is choosing the best people, the most diverse people for your organization. And on the flip side, I would say that's making sure that your algorithm's not biased, and that means you're not having problems with the use of it. So moving to the frameworks, we did create, and it's on the web, available on your desktop and mobile. We did create a toolkit for board members, because when we surveyed our 1,000 odd members, we found that a lot of board members really were not very digitally literate and didn't understand what AI was, and yet in many cases they were now being asked to have oversight of the use of artificial intelligence. And so the toolkit is specifically aimed at boards. So their oversight responsibilities, if you're in the audit committee, what are your responsibilities there? And now we've moved on to thinking about what the C-suite should be thinking about when using AI, because we've moved from perhaps the Microsofts and Googles and Salesforces of this world, to everyone having to be an AI company. I don't think in the post-COVID world that companies that don't use AI and don't use AI responsibly will survive.
Thank you very much, Kay, for this thoughtful answer. A lot for us to consider and think through, and we will be coming to you for additional perspectives and insights that would be of interest to the financial and family office community. I would like to go now to Sylvain Duranton. As Angelina mentioned, Senior Partner and Managing Director at Boston Consulting Group and the global leader for the BCG Gamma, and all of the exciting work that is being done now by BCG Gamma across the world. I wanted to go straight to you on some of the things that Dr. Kay has touched upon. She touched upon issues that are responsible AI, ethics. We see examples, Sylvain, every day now that cognitive bias is prevalent in data scientists. We see a lot of the unfair issues that exist in our society. It means that when AI solutions are scaled, there can be regulatory, reputational, and legal risks. And we are seeing companies, great companies, IBM, Microsoft, Goldman Sachs, Amazon, Google, Facebook, already have algorithms that are being investigated, legally challenged. How do you see it from the BCG's perspective and your own work over the years on ethical questions that are making a difference to companies' bottom lines, with all of that being said?
Thank you, Mark, and thank you all for inviting me. And I'm very happy, Dr. K, to be speaking with you, because I'm advocating a lot to companies that if they don't have ethics AI officers, they are in danger. And so I'm happy that you were the first one appointed in the world, because this is truly best practice for everyone. Yes, it's an issue, and it's a complex issue because you have two levels. The first one is you have blunt, unintentional blunders which happen because AI is a super sensitive matter that needs to be dealt with care. And you have things like, we know Watson has been, pushing for some unsafe cancer treatment at some point. We've had, the scandal in New Zealand where people from Asia were systematically stopped at the border because the robot that was checking on passports basically felt they had closed their eyes, so they were shutting them from entering into play. You have Amazon, which was, advising people to do some combos, and those combos happen to be bombs or whatever. So you have unintentional part. And here to deal with that, you need super rigorous process to manage AI. And today, in many companies, those processes do not exist. And on the other side, you have to think through what is being fair. And that's a difficult question for many companies, because many companies relied upon, common sense, moral values of people confronted to dilemmas. Once this is centralized into artificial intelligence engines that runs nights and day, you need to tell them what's fair or not. They cannot guess what is fair. And we deal with sensitive topics now. Through AI, you can know just by one picture, Stanford worked on that, the sexual orientation of someone. Good, not good. Extremely, what can you do with that? What can you use out of that? This is posing new questions to companies. So for me, that these are the two dimensions that needs to be checked. How robust are we from our process standpoint? Do we have a chief AI ethics officer? Are our model systematically peer-reviewed and tested? How robust is our technology? What sort of data are we using? Are we archiving everything we did on data? And on the other side, what's fair? And one example is quite interesting. You've heard a lot in the US about, or in North America, about the clockning phenomena, where using labor schedule optimization, people ended up having, horrible schedules, much more horrible than what the human managers would have scheduled, because, they didn't take into account what, the well-being of people. On the other side, with those exact same engine, you have companies who use those tools to improve not only quality of service, cost, or whatever, but explicitly improve the well-being of their employees. So on the ethics part, beyond technicalities, beyond other bias in my data or not, there is this thing which is, what do you try to optimize? And I've been working a lot with airlines on how to optimize airport operations when you have disruptions. Some airlines will tell you, I want to minimize cost. Some airlines will tell you, I want to maximize my customer satisfaction. That's typically the decisions that need to be formalized, through the functions like, those chief AI officers in companies, and where we need to create awareness. One key best practice is to make sure that there's a process to test AI. When we do AI, and we sell that tool to clients also, we have a tool called rate.ai where we assess on every dimensions from, the frameworks that have been developed, for instance, by many global institutions. I think we counted more than 84 frameworks on, ethical AI, and turn that into concrete things that needs to be, assessed before working on the use case. That gives you a score, and if this score is on the red or orange zone, then you need to escalate and to have a discussion with people in the position of Dr. K, for instance. It's a serious matter, and as investors, you need to make sure that companies you invest in are serious about dealing with this risk.
Thank you very much. I want to stay with you a little bit, Sylvain, and then go to Dr. K for some very interesting questions, again, exploring ethics and sustainable investment further. I want to talk to you, Sylvain, regarding the big focus now on human-powered AI companies. Obviously, the companies are run by humans, but there's a whole transformation now in enterprises focusing on human-powered AI companies where we will work with machines, but humans have to be really on top of the situations. We must elevate humans to the higher value tasks to benefit organizations and benefit an employee career progression and work satisfaction. In fact, according to Business 20, digital education, including teaching the necessary skill-based work and interacting with the emerging digital technologies is very important. And humans must be ready and have the final say. What do you think? How do you think humans must control the future of AI when everything is AI is becoming automating our financial industry, our healthcare is involved, critical systems. What could humans do to control the future of AI?
So, you have a bit two camps in the AI world. The camp which thinks that in the end, companies will be one CEO and one AI, and very few people employed. And I'm on the other camp. My conviction, my deep belief, is that the future of AI is exactly as you said, Mark, to be everywhere, every function, every sector, supporting people to do their job better. A bit like we could say, computers and IT has been doing for some years, basically. That's my vision for where AI is going. Now, can I substantiate that vision? We did recently a survey with MIT, and we surveyed like 2,500 executives across companies, across the world, across sectors and all that. And what we see is that companies who invest in that human plus AI concept have 6 times more chances to make very significant profit improvement versus others. And when I say very significant, I'm with investors. It's, we're talking 3 to 5 percentage points of margin improvement. Across sectors, this is achievable. Then what is this? And you're asking the key question, Mark, which is, how do we organize this sort of collaboration between humans and AI? And you have a variety of systems. Sometimes AI has to decide. It's real-time decision-making. It's not high-impact decisions, like you send promotions or some things to people, personalized promotion for coffees or stuff. There's not high stake. And here you will ask human to steer the model, to look at results, to check for biases, as Dr. K was mentioning. Thinking through the objective function, what is it that I'm trying to optimize and I'm asking AI to optimize. In some case, AI will give insights. That's what we do a lot in healthcare today on what could be a better treatment, what could be the best treatment fitted for this specific patient, given the biometrics that we have. And then a doctor can make a call, based on that thing. We sometimes have the opposite. In the industrial world, you can infinitely change the way you put machines and industrial equipment within a manufacturing plant or a warehouse. And here, if you want to find the best solution, the combinatorics are so huge, AI cannot even do that. What you do in that case is you have humans who know, engineers who have a sense for what could work, proposing scenarios to AI, and the AI will assess whether this is robust or not, whether this will save cost or not, whether this will improve service levels or not. The point I'm trying to make is there's not one model for AI and humans to collaborate, and companies who experiment different models tend to make much more profit out of AI than the others. And we call these ones the learning organizations. And when you learn, one critical point, which is also making AI much safer and much more robust when it is used, is to invest in real feedback loops. Not like, setting a model, testing on, past things and then running with it for years, but keeping a part of the process where some humans will check the results and challenge the results. And Dr. K was talking about recruiting biases, for instance, which we know exist at university when some university use AI for, to screen students, within company to screen resumes, for instance. With the best intention, AI will be biased because AI will replicate the success of the past. You can spend hours with data scientists, try to test to unbias and everything. What you can do is force rules to stop bias, and you enforce those rules to AI. But the other key thing is to keep some CV screening based on humans who might start to test new profiles, new type of curriculum, new types of people, new types of geographic origin, ethnic, and all that. And then they might discover things over time which are better than what AI was trained upon. So keeping those real-world feedback loop into what we're doing is absolutely critical to make these things work. And it's at the core of the human plus mindset. Sorry, Mark.
Thank you very much, Sylvain. I want to, in the interest of time, go to Dr. K again and address the issues now we are seeing on television and media. There's a series of misconceptions around the state of AI, and a lot of it is affecting reflections on ethics. I know that the World Economic Forum has a vision to solve global problems with AI, and why it takes each and every one of us to be part of that solution. And maybe Dr. K, if you could talk a little bit about this approach of ethics and AI in the right way, and how do we, all of us across the world, be part of this solution, this new positive view of the world, this ethical view that will certainly reflect the views of many investors and many organizations. To you.
Yes, certainly. So may I first, and in fact it does begin to answer your question, may I just first add that one of the things that I think we really need, and Sylvain was talking about, is that we need to have mixed teams. So the best models are being created by teams that are mixed. So not just your engineer, but also your humanities people. And so creating those teams, those diverse teams in terms of the way that they think, but also gender, etc., and race, that's really, really important when we're thinking about, and when you're investing, have a look at the teams that are creating the AI. So I wanted to then go on to the AI for good. The forum, of course, has been talking about the Great Reset, and you'll have seen Professor Schwab's book on that, and also about ESG. And recently we've been saying, well, maybe T needs to be in there as well, because if we're right,
connected. 2 devices connected.
Sorry. Yeah. So because if we are right that AI will be everywhere in our future, then we need to be thinking about how we are educating children.
Smartphone disconnected.
AI there. And if we are using AI, AI can be a very manipulative tool. as well as a very useful tool for education. And so we've been working with UNICEF on thinking through those issues around AI and children. But also, when we think about healthcare, we need to think do we keep the human in the loop? How do we explain what the AI is doing? And then we think also about climate change, for example, and the use of AI there to help us with models. And so basically, I sort of say often we're looking to AI to sort out the problems that we humans have caused for ourselves so far. And that's what we think about when we think about AI for social good. But actually what we should perhaps be thinking about is something wider than that, which is with all the problems that we have, do we want to rethink and do we want to use the capacity of AI and quantum to really rethink what our society should be looking like and what our investments and our companies should be doing?
Thank you very much, Dr. K. From this point on, you touched upon what companies should be doing. You touched upon that there are a lot of responsibilities. The whole social structure may have to really be discussed at all levels. So it's already being discussed at a very strategic level, the work that you're doing at the World Economic Forum, touching upon many governments and many countries, as well as from the political, business, enterprise world, G20, huge discussion. But coming in from, we're seeing all those talks about mimicking humans. There are discussions about, Dr. K, the rights of the cognitive software itself, depending on the political and judgments, court judgments, and in fact, probably in your neck of the woods, you are very familiar, legal loopholes that potentially could lead to a legal, and I want the investors to understand this, legal AI person status. We are seeing cognitive agents and robotics such as Sophia receiving the status from a number of nations, and more is to follow. Will they soon gain complete legal AI person status? What are the implications of the robot rights and citizenship in our governance structure? I know it's kind of taking us into the future, but it's probably of interest to a lot of the different investors and different organizations.
Yeah, I think that it's actually mostly of interest because it's about where the legal burden lies. And so actually the EU played with the idea of legal personhood for AI and decided, I think on the advice of a number of us, including myself, that it was a really bad idea. And I think that the sort of citizenship that you're seeing being given to robots is probably a bit of a show rather than actuality and something that we need to worry about at the moment. What I would prefer us to worry about is getting the AI right, setting the right foundations for our use of these tools so that we really can benefit from the use of AI. And so I'd rather sort of put those issues on one side and say, okay, so what are the right legal frameworks? So if company A sells an algorithmic model to company B, what is their liability? And so on. And should they, for example, like blood diamonds, actually have to say, this is what I'm selling you, so that company B knows what's being sold, and we have some sort of legal tracing through that. And one of the pieces of work that we're doing at the moment on our responsible use of technology work stream is, let's look at the product from the moment the engineer thinks of it to the moment it goes out of the door. And because it's AI, do companies need to think about it beyond the moment it's gone out of the door?
Thank you for that point. Of course, a lot to discuss. We are limited in time. I want to ask One more question to Sylvain and to you, Dr. K, and then go to my colleague Angelina for final closing and the final closing statement and the question. But before I do this, I want to go to you, Sylvain, and talk about, as we're dealing with now the investment and family offices community, you and your organization at BCG Gamma have looked at hundreds of AI, societal, sustainable solutions in AI. Can you tell us a little bit about the ones which are groundbreaking, the ones which are converging digitalization and AI and creating this impact? Where are they come from, and what's the adoption rate, and how do you see sustainable impact investing playing in this role from the investor's point of view? So a number of different things related to solutions and actual companies and with their adoption rate. To you, Sylvain.
Maybe two topics to share on that, Mark. So from an investor standpoint, you should aim between 3 to 5 percentage point of margin improvement into companies which are investing in AI. This is totally achievable. Companies have achieved that around, across sectors. And, the current environment is making things even better for those companies. And we have a database of, 500 companies where we check on market capitalization evolution, and we look at also their AI and digital maturity. They were outperforming their peers pre-COVID, and since COVID hit, the gap has been widening very significantly. That dropped less during the frozen phase, and they've recovered much faster. So the first thing as an investor is to make sure that there is a bold and credible AI and digitalization plan into the investment you make, because companies who don't have that will be underperforming for sure. And credible means there needs to be some investment after this. It's not just appointing a sort of CIO, CDO, chief AI officer, or whatever. These are teams, these are serious matters. Now, in terms of what's groundbreaking, you have many areas where AI can be very groundbreaking, in sales, in pricing, in different things. One area which is fascinating to me, because we're solving some of the most complex problems in the world, is a bit what you alluded to, but what can be done in the social impact arena. You see that, using AI today, we've built models to help, WWF fight illegal deforestation in Indonesia using satellite image to really spot areas that were difficult. We've worked with Save the Children to identify when there's a crisis. Big question is, will it be a small or a big crisis? Because if it is a big crisis, children will be the collateral damage for sure, and they need to act extremely fast to bring relief and support. We've worked, you were talking about education for some of the US counties in poor neighborhoods to identify which kids going to school were at risk of being murdered. Okay, so you see the immense benefits that you can derive from AI, and as investors, putting pressure on companies to know whether they use AI just for financial return, and how much do they give back to their employees, to their customers, and to the world is also a very important criteria. And lastly, as investors, I'm sure you are following ESG ratings and this type of tool to taking this into account in your investment. And we've done work at BCG showing that total societal impact is a true driver of financial performance. Today, ESG is being revolutionized by AI. Most of the ESG companies, they work on questionnaires and declarative efforts done by companies on what they're doing on ESG. Using AI, scrolling the web, using machine learning, you can get to what's behind the hood, what's really happening in terms of ESG with one given company everywhere in the world, with their plans, with their unions, with their people, their products. And that's shedding new light in the whole ESG arena. So
thank you very much, Sylvain. Great points. You've given us a lot to digest in terms of where it's going, some of the companies that are involved in this space, and how are we going to really tackle some of those complex issues. I want to bring one question to Dr. K. and that has to do with the at least the closing question for me, and then we'll go to Angelina to close this out with one final thought about the humans and our jobs. So I'll leave this to Angelina. But for right now, Dr. K, as you're doing some phenomenal work, and especially during this tough pandemic, the COVID-19 crisis, the public health has been impacted around the world. And of course, it has deployed a lot of AI. Some of this AI has not been thoroughly checked in terms of the efficacy and privacy. We discussed it many times, but it does include areas of tracing and surveillance. It is very easy for hackers to break into the system. There are privacy issues. Are there some advice that you could give on the work your great teams are doing around the world, advice to enterprises, to entrepreneurs, to investors, how to keep a lot of those AI systems secure during COVID-19 as we're introducing all this technology, where hacking or privacy or transparency issues could be coming in from both state and stateless actors? How do we deal with all of this complexity? And what is your guidance for all of us?
Yes, well, I think that's the $1 million question or $64,000 question or whatever it is now in inflation, because we don't know the answer to that. What we do know is that companies need to be very, very careful, but we've known that for a long time. We know that that data privacy is one of the major problems which cause backlash or techlash against AI. We also have seen techlash against AI even when AI wasn't being used with some of these COVID tracking and tracing applications. And so I think one of the big things that we should be thinking about is how do we help the public to know what we know? Because if the public doesn't know what we know, then we have the possibility of more techlash, which will actually impinge upon the value of AI and the ability of us for using AI, which is, of course, what takes me right round full circle to the fact that every company you invest in, have a look at their ethics in AI statement. And if they haven't got one, either don't invest in them or make sure that they develop one, because it's crucial for your investment. And I think it's particularly crucial at the moment. If you look at Apple, it's sort of saying, you can trust us. I think that move by companies to be the trustworthy company is going to prove who are the market leaders in this area.
Thank you very much. I may just borrow a little bit of time from Danny and just small follow-up from you, Dr. K, before I go to Angelina for closing. You're seeing a lot of sustainable impact investing in the world, in the communities of the World Economic Forum. What is their perspective? What are they seeing with AI right now? I think it would be of huge interest to our community here. Maybe if you could just briefly outline some of their interests and their concerns.
Yes, so I think sustainable impact investing, Sylvain talked about some of the places. In education, in agriculture. So specifically in India, for example, we have a project around thinking about the use of AI in agriculture from using satellites to look at crops, using IoT devices to give information about soil structure, water, things like that, and then use AI on that and to help the farmers make the right choices. But then the next stage is how do we get it from the farm onto the table in India? So there are whole chains, supply chains, all of which can have AI applied to it for the benefit of the farmers and those purchasers and the companies that are involved. So I think that agriculture is a great place to start if you're looking at impact investing.
Thank you very much. I want to go quickly. I know that we're already getting flagged by our esteemed organizers, Danny and his team around the world. They're giving us a little bit of extra freedom, but I want to now go to still my colleague to do a closing question, and the closing questions has to do with our future of all of us, our companies, our leaders, and our next generation. To you, Angelina, to close this out with a final question to our participants, and then we will bring this back to Danny. Go ahead, Angelina.
As we've seen in the fourth industrial revolution, AI has altered our workspace, our office space as well. It has created numbers of new jobs. So I'm interested to hear for a final and closing thought. What are your thoughts on the future of AI? How will the future of AI landscape look like? And how will the future of work look like? What can we expect in those terms? So we can start off, Dr. Well, actually, yes, you can go with Sylvain. Go ahead.
Okay. So as I said, I believe the future will be a human plus AI. So every human will need to be trained and skilled enough to, interact with AI. And the recent announcement that Walmart was taking out the robots to fill the aisles in the supermarket, I think, is a very strong sign that the vision of full automation is not there. And to me, the winners for the future in AI will be companies who will be basically mastering three things and putting three things together. External data, and having access to external data is proving more and more critical, and this has accelerated with the COVID crisis. Their own internal data, obviously, and people, and starting this loop and this virtuous circle of a learning organization and making sure that human intelligence, data, artificial intelligence are taking better decisions for the better goods. And the critical questions company will have to tackle is what part of this AI should they buy off the shelf from providers? And you have tons of providers who provide services based on data, and the GAFAs and their Asian versions are the best example of that. Or where do they need to build their own solutions because they want to remain different, more competitive, unique for their customers? This will be one of the key questions for those players. And the more models will become complex, the closer we will be to general AI, the more ethical questions, robustness questions will be critical, because testing general AI or AI which is broader than we have today will require even more work. And people are sometimes seduced by the fact that AI is behaving like human, so we can trust AI. AI is not behaving like human, and AI should not have citizenship. And my last point will be food for thought. Gary Marcus and Ernest Davis, in their last book on AI, they remind us of something very interesting. None of the AI robot, and this has been tried a lot by researchers, is able to open a door. Any door in a room or any door in a house. Things that kids know how to do. No robot can go to regular houses and find how to open the different doors without keys. Just to show that even if we have robots that tend to try to look like humans, we are dealing with something which is fundamentally different and a complement to what we are.
Thank you very much, Sylvain. And now we go to Dr. K for the final thoughts, the question from Angelina.
Yes, absolutely. So Dr. K, I see you've been agreeing with his point of view. And I would like to expand on that a little bit more, because I'm sure you have a lot of insights that you can share with us. So how will the future of work look like considering AI, and how will the future of AI landscape look like? What is your opinion and your perspective on that?
So I think that I can just say I agree entirely with what Sylvain just said, and move on to the future of work. So our colleagues have just produced actually a future of work report. And so I advise people to read that if they want to think about the future of work. But I do think that working with AI or robots is going to be the way that our children find themselves in their working environment. And that is for the best, for all the things that we've heard today. In terms of what's the future of AI, I think the jury's out. I'm not sure that through machine learning that we can actually get to super intelligence, but it may be a combination of some of the techniques that we've seen. I tend to be more concerned at the moment with making sure that we have good ethical foundations for what we're doing at the moment, and leave it to professors like Stuart Russell to really think about our future and the advent of superintelligence.
Thank you very much. I would like just say before passing to Danny that what an incredible panelist that we have. Thank you, Dr. K, and thank you, Sylvain, for giving us that intimate knowledge about the role of ethics and responsible AI in investment, in addressing really strategic issues. Where are we going with enterprises and really the future? And really enjoyed this. We want to give a big round of applause to you both for being with us and sharing your knowledge and your expertise and all your lessons that you have gained over the years in some incredible situations and experiences. And thanks, Danny and DC Finance, for giving us the opportunity for Digital Pioneers Network to present this panel on technology and AI. And we really are excited and looking forward to coming back again on November 18th to discuss with American audience. Thank you so much again. Great job.
Thank you, Mark. Thank you, Kay and Sylvain. Thank you so much for being here. So what's coming next is Joshua Robin, philanthropic advisor at the Jewish Community Foundation of Montreal. We had last, I believe, week, we had Kathy speaking with Sylvain Adams and Sharon from the Tel Aviv University Friends organization. So I'll let you take over, Joshua.
Thank you so much, Danny. I'm very grateful to be here for not only for 10 minutes of speed dating with you, but also just grateful that philanthropy is on the docket again. If you, like Danny just mentioned, October 28th, our executive director, Kathy Asiag, was on a panel with Sylvain Adams and Sharon Frankel. If you didn't have a chance to watch that, I suggest you watch the playback because it was great. They're talking about how the landscape is changing and how more people are actually being philanthropic in this time, just like, the last crisis the world faced, economic crisis, 2008, 2009, it was actually a very philanthropic time. So people are stepping up once again. So I'm just grateful that philanthropy is back on the docket. And so if we're starting off this speed dating, I'll let you know who I am. Joshua Rubin. I'm a chartered accountant. I've worked previously in the tax departments for KPMG and PwC. I met with Bobby Kleinman, who's been with the Jewish Community Foundation for 25 years. I'd seen him at a few different things and decided to join the team. If you don't know Bobby, he's a pillar in the Montreal community, and he's literally wrote the book, the Gift Planning Handbook, for Canadian gifts. And actually the version 2.0 is going to be available on our website shortly. So it's great to be working with him, great to be working with Kathy Asiag, and now I work as a philanthropic advisor with the Jewish Community Foundation. So what do? I meet with donors. I help them be intentional about their giving. I talk to them about what they want to get done, and we use the best, my tax background comes in handy because we use the best giving strategies to maximize their impact. It's very rewarding. No, definitely not looking back to go back to public practice. This is great work. So who's the Jewish Community Foundation? So we've actually been around it's our 50th year this year. And we're we're a registered charity, but we're also what's known as a public foundation. People can set up a private foundation. I can set up the Joshua Rubin Foundation with Canada Revenue Agency and have my own sort of, philanthropic efforts that I'm running by myself and have to do different things for a private foundation. But we're a public foundation. We like to think of ourselves as an umbrella for many different funds. And that's what we do. We have over 2,400 individuals and families that have funds at the Jewish Community Foundation. Our goal is really to promote philanthropy. That's what we say our mission is: promote philanthropy in any way, shape, or form that it comes. And don't be misled by our name, Jewish Community Foundation. Originally, we were set up, to be there for the Jewish people, and endowments and legacy giving, if you will, memorial funds and things like that. But over the last 20 years, there's definitely been a shift. Our doors are open to everyone. You can see it not only by the makeup of our fund holders themselves, but also by where the money is going. The donor ultimately decides how the money flows out of the foundations, out of their respective funds. And the money last year went to over 1,000 different Canadian charities. So just tremendous work from our fund holders. Like what I was saying, originally we were founded for very long-term giving, but over the last 20 years, we've built up an expertise in tax-efficient giving, and really being donor-centric, meeting with our donors, figuring out what they want to do, from the smallest projects to the biggest overseas projects, to see if we can help them get their philanthropic goals achieved. So that was a very long-winded introduction. I'm flying through it because, like I said, speed dating, you got to get to know me, get to know the Jewish Community Foundation. And so, if I'm going into the second half already of this, is what do I want the takeaway from our short meeting to be? I think it's that you have, sorry, I was getting, people were chatting at me, beauties of these Zoom conferences. I'm not gonna end up showing a video, so you're gonna see me, but I will share my screen. So the takeaways that I want you to have is that you have options. You've got gift options, you've got advice, you've got people that can help you, you've got different types of funds that you can open. So it's a lot more complex than maybe you know, or maybe you know about the different ways of giving, but you have advice not just from the Jewish Community Foundation, but from your tax advisors, from your brokers. Talk to them about philanthropy. If you're not already, have philanthropy as part of your portfolio, it's definitely something that you should be thinking about. So what is smart philanthropy? Smart philanthropy to me is just giving finding the best giving option depending on your tax profile, and for you to be able to give the biggest amount of money for the least amount of tax impact. So that's smart philanthropy. I'm going to show you really quick. I'm going to share my screen, because you can't really talk about smart philanthropy without talking about a donor advised fund. This is our flagship product, if you will. The donor advised fund is very simple. It means you're centralizing your philanthropy. We like to think of it as a bank account for your philanthropy. So you have here John. John wants to make a tax-wise deposit into he can call it whatever he wants, the John Smith Foundation, the Smith Family Fund, whatever, as long as the name's not taken in our system, you can choose that, and you can get the recognition when you're actually giving monies out to charity. So you're centralizing all your philanthropy in this one fund. You're getting one tax receipt instead of chasing around. Let's say you're giving to 25, 30, 50 charities in any given year. Instead of chasing around all these tax receipts, you're getting one tax receipt up front. And then you just let the JCF, we operate as your back office. You let us know, send $500 here, send $1,000 there. Throughout the year, we help you do this. And we actually have an online portal. It's like online banking, that you can actually go in and make your donations like that. Usually there's a lot of back and forth, a lot of questions right now. You might have tons of questions. So I'm just gonna pivot quickly. I'm gonna share again. And if maybe one of the takeaways, I'm just going to, can you see that? Can you see you're on the Jewish Community Foundation website now?
Yep.
Perfect. So we have, different, if you Google Jewish Community Foundation or JCF Montreal, you'll get a hit on our website. You have so much more information. We have smart philanthropy. You've got the different types of funds that you can open. You've got the giving options. So we talk about those smart ways of giving. We're not talking about just cash. We're talking about gifts of securities. We're talking about gifts of life insurance, gifts using charitable remainder trusts, all these different tools, and even gifts of preferred shares. If you have a private company and you don't want to give cash or impact your cash flow, that is something that we specialize in at the JCF that not a lot of charities do. We also have, if you don't want to necessarily talk with me or ready to talk with someone at the JCF, we have calculators available on our website. They're simple tools right now, but you want to see what a gift of marketable securities, how that's going to, impact you. And you can, plug in some numbers, watch a video on how a gift of securities works. Tons of tools available at your disposal. This is what I was talking about before in terms of, kind of what we offer. My time's coming to an end. So I'm just going to urge you to check out our website. Think about adding philanthropy to what you're doing, especially with everything that's going on. The JCF and other people are waiting, standing by to assist you in meeting your philanthropic goals, and just have a conversation, learn about what you want to get done, and then see if there's some tax savings to be had as well.
Thank you so much, Joshua. And now we're moving to our next part, which is the financial element of the conference. We're going, I welcome again Scotia, Andy Nasser, Chief Investment Officer at Scotia Wealth Management, and Jacques Maurice, Director, Wealth Management, Scotia Wealth Management. Good to have you back, and we'd love for you to give us your thoughts about what's going on and your insight. Thank you.
Thank you, Denny, and good afternoon, everyone, to our presentation. And special thanks to the U.S. and the Canadian Family Office of High Net Worth Individuals for the invite. My name is Jacques Maurice from Scotia McLeod in Montreal, and I will be joined for this presentation by Andy Nasser, our Chief Investment Officer from Toronto. The world is going through an unprecedented period of which combines a huge increase in debt worldwide, along with zero interest rates and negative growth. The mix of these three variables in that direction and in current proportions never occurred in the history of mankind. To an already overstretched world economy at the end of 2019, we have added like $12 trillion of debt for which we had no choice. Government will have to redress these balance sheets, and with the overall world debt at 100% of world GDP as we stand, they have like exhausted almost all buffers. Over time, government will need to pay back the debt through a combination of raising revenues and reducing expenses, but that will create inflation. Which class of assets will benefit from this combination? Our best protection will come from well-chosen equities, which will benefit from higher inflation. We also can say that the traditionally balanced portfolio of 60% equities and 40% fixed income is really being tested right now. As Government of Canada 5-year bond stands this morning at 0.39 of 1%. So here at Scotia in Montreal, we run our portfolio strictly with the use of Bloomberg research, having in mind of reaching reasonable returns with a combination of dividend and capital appreciation with the lowest possible risk and only with big capitalization. On the Canadian market, we're looking for monopolies. We're therefore looking for 5 special sectors: the financials, the food companies, the railroads, the telecommunication companies, and the pipeline, which we call infrastructure. We therefore have no oil, no gas, no metal, no airline, no car companies, really like nothing cyclical. No conventional car companies, because Chinese government wants electric car by 2025, that is in 5 years from now, to go from 5% to 25%. In coming years, everything that will move will be electric and autonomous. Electric cars will be able to go from 400 to 600 miles on a single charge because battery technology is getting much cheaper. We see the crossover point with electric vehicle versus actual gas type of cars vehicle in 2023. And no oil because there's an environmental economic wave going on, and there is opportunity right now in carbon neutral and carbon destruction stocks favoring renewable and wind energy. Please note that the majority of our sectors have company paying at least 4% dividend with the applicable dividend tax credit in Canada. On the American and European market, we own big multinational that we cannot buy in Canada, like the Visas and the MasterCard and the Honeywell of this world. But more importantly, some of the biggest pharmaceutical and technology companies in the world. And technology, because there's so many hot technological breakthroughs, such as 5G internets and robotics, artificial intelligence that we just heard about, and virtual reality, blockchain, and quantum computers. 2 years ago, our two biggest positions, as you know, in our books were Royal Bank and TD Bank. Today, they're Microsoft and Google. We run our typical portfolio 70% US dollar and 30% Canadian dollars. And note that we don't buy mutual funds, and nor do we buy like ETF. On the fixed income side, we like retractable preferreds and preferred shares with minimum, or what we call floors, like the EMRA 4.90% preferred, for example. Once again, we like Canadian dividend, where the dividend tax credit. Just keep in mind that, like in Canada, on income, you pay 53% tax. On dividend, you pay 37% tax. And on capital gain, you pay 27% tax. We're also considering seriously starting to buy some of the Canadian real estate company known as REITs. We don't own them right now, but we're looking at them very seriously as their price collapsed 50 to 75% this year. We can now buy them at 25 to 40% discount of their net asset value, and their yield is roughly 5 to 7% distribution on almost all of them. We're also keeping 10% in savings account, considering that the stock market is like highly disconnected with the economy as we speak and extremely volatile, particularly with the surge of a new president, as we all hear. In closing, if you're a prudent investor and that our investment philosophy is suitable to your objective, our group of 25 portfolio managers and administrators that already manage more than $7.3 billion would love to hear from you. And now I'm going to turn the meeting to Andy Nazar in Toronto, who's like our chief strategist. Andy, you're on.
Great. Thank you, Jacques. It's a pleasure being here again. And what we'll do today is just, I was listening to the earlier part of the presentation. There was a lot of really good information. I think what's useful is maybe if we just distill all of that information about the economy, how it's evolving, growth, interest rates, inflation, and just draw a couple of key conclusions. So first and foremost, Jacques alluded to this, but market volatility, financial market volatility is likely going to remain elevated, not just throughout the remainder of the calendar year, but as a consequence of how integrated and synchronized the global economy has become. And it's important because that has implications for how we allocate capital. We want to make sure that portfolios are well diversified enough so that we have an opportunity to take advantage of this market volatility. We're never going to be able to get rid of it, but as it pertains to certain asset classes, certain sectors, certain securities, we can certainly pounce on it and hopefully compound capital at much higher rates. So market volatility is elevated right now because of policy risk, because of the presidential election and the uncertainty there. But in addition to that, as we move forward, the global economy is going to grow in our view, and global growth is going to accelerate once we're through the worst of the health crisis, but it is very likely that interest rates and inflation remain anchored at relatively low rates. And you heard a little bit about this earlier, but we do have an economy that is excessively indebted. We have demographic issues that we have to overcome. And so all of that excess debt is going to have to get managed prudently. And if interest rates and inflation are going to remain relatively low, that means that financial conditions are going to remain accommodative for the foreseeable future. And that's what's going to create some opportunities for us short term. The global economic growth forecast is for an improvement in 2021. Not many economies are going to achieve pre-pandemic levels of GDP toward the end of next year, especially given some of the second wave risks that we're contending with as it pertains to the health crisis. And many governments right now are running sizable fiscal deficits. And that's important because the narrative is likely going to change as we move into 2021. A lot of money was spent to try to contain the health crisis and bolster growth subsequent to emerging from it. The reality is that as we look forward, many governments are going to have to thoughtfully think about how to stimulate economic growth and really improve the output potential of their economies. And that's why, if you think of the implications for the election in the United States, both the Democrats and Republicans were running on platforms that included significant fiscal stimulus, either in the form of infrastructure spending or making the economy a little bit more green or environmentally friendly. Regardless of who wins in the US, and this is the trend that'll likely spill over into other countries, we think that fiscal spending is going to become that much more important, especially considering that interest rates are very low. In some parts of the world, governments can borrow at rates that are zero, if not negative. So they get paid to issue debt. And in that sense, these fiscal initiatives make a lot of sense. Thinking of just looking through the pandemic very quickly, this is probably the biggest headwind as it pertains to short to medium term economic growth. Obviously, many countries and even some states in the United States or in the US are considering lockdowns. And so that can have an impact on those economic growth forecasts, and that's what can contribute to the volatility next year. It has less to do with the election. It has more to do with estimates as it pertains to growth, not just for the economy, but for certain sectors or asset classes. Equities tend to discount future growth, and right now they've run up in anticipation of the improvement that's expected in 2021 and beyond. And if you think of equities more generally, many investors and many analysts anticipate that corporate profits are going to fully recover by the end of next year, which is unlikely given some of the headwinds that we're dealing with as it pertains to the pandemic. We talked about the massive stimulus that's been put in place. Just to contextualize this for you, there is about probably going to end up closer to $30 trillion in monetary and fiscal stimulus that's been coordinated, many governments, almost every corner of the world. And that equates to that will equate to over 30% of GDP. So the increase that we're seeing in government debt, it's something that we're going to have to manage, especially considering that central bank debt has quintupled since 2007. It's widely recognized that some combination of monetary and fiscal policy are necessary when the global economy encounters a significant crisis. That's what we're dealing with now. That's what we dealt with in the global financial crisis. So the reason that global indebtedness has been ratcheted up since 2007 is because we've really made a concerted effort to stabilize economic growth amidst two very significant crises that have affected the stability of the global economy, not just our domestic economy. We talk a little bit about inflation and interest rates. The reason this is so important, and I won't spend a lot of time on this, but the reason it's so important to understand how interest rates and inflation will change over time is because we use interest rates to discount cash flows and ascribe fair value to different asset classes. You do that for real estate, you do it for equities, for bonds. So having an idea of how interest rates and inflation will evolve helps us determine where fair value sits. And we can use an expected return framework that ultimately guides us with respect to identifying opportunities for capital allocation. And that's what's going to allow us to, as I said, redeploy the capital within portfolios and hopefully compound them at a much higher rate. The global economy one of the things that's going to anchor interest rates and inflation is excess indebtedness. I think this was talked about earlier, but government debt is really ramped up. But let's not mince words here. The global economy, if it's composed of governments, households, and corporations, which is an easy way to think about it, it's excessively indebted, and every country has their own issues when it comes to where the indebtedness resides. In Canada, we have excessively indebted households. Many other countries, it's the government. China, it's corporations. And this just warrants selectivity, but it also warrants being conscious of the levers that governments can pull to try to affect a tangible improvement in economic growth and really stabilize their individual domestic economies. As it pertains to the election, I'll just address this because I'm sure we're going to get a question about it. The reason that we're seeing a broad-based rally in the markets, this has not been updated for today, this was updated yesterday morning, but the reason that we're seeing a broad-based rally in the markets is because it's very likely that we end up with a divided government in the US. And if the government's divided, meaning that no single party controls the White House and Congress, the House of Representatives and the Senate, it becomes that much more difficult to push through transformational policy. So all the concerns that people had about the Democrats wanting to increase corporate and personal taxes for high-income earners, all of those things tend to fall by the wayside. And in fact, we tend to solidify the view that interest rates are going to remain relatively low for the foreseeable future, and that in the absence of this significant fiscal stimulus that the Democrats were planning, that we're probably going to have to rely a little bit more heavily on monetary policy, meaning that rates could remain lower for even longer. So in that context, when we think about how to position portfolios, the two biggest asset classes in the world are equities and fixed income. They perform very differently. Equities tend to follow corporate profits. So the conversation that we had about the economy and growth, that goes hand in hand with the view on corporate profits. And fixed income still serves a purpose in a portfolio. If you're a fixed income investor, you're lending money to either a government or a company, and you should end up with a very stable and predictable return, provided that the entity that you're lending money to doesn't default. Governments very seldom default. They tend to be viewed as the risk-free asset class because they can always print money in times of crisis. Corporations do tend to default. And what we've seen more generally is a flight to safety that is depressed government bond yields, and we've seen a little bit more turbulence in corporate credit. But the purpose of fixed income in a portfolio is to act as a ballast, provide predictable returns, and we can rely on that fixed income exposure as a source of capital when those other opportunities present themselves. The reality is that when we think of equities, I accidentally skipped the equity slide. The reality is that when we think of equities, they tend to provide much higher returns than fixed income, commensurate with more risk. Because, as I said, equity returns and corporate profits go hand in hand, and corporate profits are susceptible to business cycles and economic cycles. What you will notice in the United States and in Canada is we've had very narrow leadership, meaning a handful of companies have pushed the market higher. Those tend to be technology stalwarts. And the reason that we're mentioning this is if you look underneath the surface, so we ignore the headline valuations and look underneath the surface, there are still plenty of opportunities that exist in the market, and equities are a much better hedge against inflation in a low interest rate environment. If you own a bond that gives you a 1% yield or a yield that's a little bit lower than that, and inflation is above that 1%, your purchasing power is getting eroded. High quality companies, the ones that Jacques was alluding to, the ones that have pointy elbows, that have monopolies or part of oligopolies, they have pricing power. And it's that pricing power that'll drive an increase in corporate profits, which will mean that equity returns should be a little bit higher than fixed income returns, given that interest rates are expected to remain relatively low. So that's the backdrop. And with that, I don't want to take too much more time other than maybe to conclude. Volatility and the trajectory of economic growth are going to remain dependent and hinged really to policy. And long-term growth, inflation, and interest rates are likely going to remain anchored for the future. The most important thing that investors can do to reduce the impact of volatility on their portfolios is to maintain diversification and really be opportunistic.
Thank you, Andy. Thank you, Jacques, very much for this session. And we will move to our next session. Andy, if you can stop your, oh, yeah, great. So thank you again, Andy and Jacques. And if anyone would have questions for you guys, please email us and we'll connect you. And now I'm going to the last session of the Canadian conference. We saved the best for last, right? I would say that. So one of the most famous families in Canada, I think the only family I met in person that's older than Canada, probably. I met in person Philippe that spoke at several of our events. I think, you know, whenever we sent to our audience, you know, the feedback letters about who are the most exciting speakers, Philippe's name comes up every single time, okay, with his energy and philosophy. And for the first time, we have Francois as well. So just a quick introduction. Philippe de Gaspé-Beaumont, a serial entrepreneur, invests in media, does philanthropy, lots of stuff, and of course invests a lot in his brother's projects, and I think vice versa. Francois de Gaspé-Beaumont, chairman and CEO of Zoom Media, and executive chairman and co-founder of Hivestack. So good afternoon. How are you guys?
Good afternoon, Denny.
I know, Philippe, you're in Montreal, and Francois as well?
I'm in the countryside, locked down because of COVID, yes.
So, yeah, we'll talk about that. So first of all, great to have you both here. Francois, Philippe, welcome back. It was great. We did a session, I think, an hour and a half long, a couple of weeks ago. So maybe you could share with us a little bit of the family history.
Okay. Well, very quickly, 14 generations in Canada. We go back to France, the 9th century, but always in business. And we've been pretty much in every type of business you can think of. We came over in the early 1600s, and we were the largest landowners at that time. Got involved in beer, lumber, real estate, and in the last 40 years, we're involved in the media business. We're the largest consumer magazine publishers in Canada, largest radio broadcasters, had television, started the cellular business in Canada with Rogers and the Bellsbergs, got involved in satellite, and now have expanded out and invested in 67 different countries with a number of different businesses, 9 different industries. And so that's sort of a quick overview on that one.
And I think Chicago, one of the cities in the States, was it Chicago that?
Yeah, so I'm going to jump in, Denny, just because my brother and my father would always tell you the glowing side of the family. You should know that in Chicago, we have a street, Beaubien Street. We were one of the, and my father, if he was here, would tell you that we built the first church in Chicago, to which I would then say, yeah, Papa, how did they finance that? They financed that because we had the first hotel that charged by the hour. We had the first bordello in Chicago. So if you dig in any family history, you will see not just some ups and downs. One of our ancestors wrote Les Anciens Canadiens, which is Philippe Aubert d'Espé, which was the first book written in New France. And he wrote it in debtor's prison. So you have ups and downs in the family history tree.
Yeah, I think the whole idea of shirt sleeves to shirt sleeves in 3 generations, we bounced on that one a few times. So, but our whole focus has always been entrepreneurship. And I think that's the key theme on everything that we're doing and our foundations and everything else, which we'll talk about more later. So that gives you a little bit of the background of the family.
And what are the top 5 core lessons you've learned from your family and your forays into business and all of that?
All right. Well, I mean, for us, one of the top ones is try and avoid being in the media eye, because we see it time and time again. We're involved with one foundation, Business Families, where we have about 10,000 families around the world, and we do a lot of discussions with them. And the main message that I keep on hearing over and over again is, when you succeed, it's great, it's fantastic, and people love to build up gods and to build them up into the ceiling. The problem is they go ecstatic to destroy them. So the worst thing that you can do for the family and for yourself is to publicize what's going on a bigger scale. I emphasize maybe focus on the philanthropy side and talk about that and what that's doing, but to valorize the success in a public forum, I think that's the real danger. That's probably the number one thing that I would say to everybody on that one.
But and just let me just jump in, because we as brothers, we often agree, but we also agree to disagree. What I would say, Denny, is that I run two companies, and you can see the Hivestack, we're a global company in that regard. But I think when you're in a certain industry, you have to make your products and wares known. And so, for instance, I chair the global industry for all screens outside the home. So if you go to Times Square, if you go to a doctor's office, you go to a gym, all those screens, that's part of industry. I'm the chairman of it globally. You need to speak out about what it is that you stand for and what your enterprise does. What my brother's referring to, though, is I think you have to keep a low profile on the personal front. The advice is, and don't get too big for your breeches. I mean, humility goes a long way. We're all human. We all make mistakes. So it's about, when he says about staying out of the public eye, I agree with him, but not if it has to do with advocating for your business or for your enterprise or for what you're trying to do, including philanthropy. When it comes to personal life, that's when I think you have to be careful.
I think my second point, and I agree with François on that, my second point is don't stick family members in the main core business as the CEO. I think that's the biggest mistake that most families do. And the problem is, we know it because we've seen it over and over again. As you grow, you need a different type of CEO, and you need flexibility. And to fire your brother, your nephew, your son, whatever, from a business is not only destructive for the business, it's destructive for the family. So the recommendation that we have been pushing on very strongly through our foundation and through our own work is find great entrepreneurs, great businessmen that will run the business, and you have advisors that are core, but at the same time have family members and a representative of each of the families on the board. That's the key. And the other big thing is encourage family members to launch their own company within the family. We call it intrapreneurship, inside the family, because most entrepreneurs fail because they have no support, no encouragement, and they have no understanding of what's going on around them. And they're only focused on one little piece. By having the family CEO, CFO, and the lawyers and the accountants helping on this, your chances of survival are 10 times better. And on top of that, you have a chance of building a company that might be the new company. That, because the other big thing that we're seeing is change is inevitable. And Danny, I mentioned this in the last meetings. I still remember the mapping industry. People, there were 5 families that dominated that business. And in a space of 5 years, they were wiped off the face of the earth from Google Maps and Waze. And those guys didn't even see it coming. And so what we're saying is have family members who have the entrepreneurial bug. They want to do something. They've been raised in a family where there's business at the table, at lunch and dinner and whatever. Go in and start their own company. And they must have 50% of it. So they must find financing for 50%. The family supports it, but it's their entrepreneurial company. And I love that part. Love that part.
So let me jump in on my brother's point. This one, Denny, for me was harder. I'm an operator. And so I was the one who jumped in and ran our publishing group, and we were fortunate to take it from losses to become the most profitable in the country. We had TV Guide and Elle and a bunch of Canadian Living titles to refresh people's memory. But I've now espoused my brother's point of view. Because I was the operator, I loved leading the company. But if you're the family member and you're the CEO, it's hard to change, and it's harder to take it from another family member, which is going to bring me to my next point, but still sticking on my brother's points. So I find that being a chairman is really good. I mean, you look at Ford, for instance, right? You could be the chairman of the family business and find a CEO to take the company from point A to point B, but it's harder if it's a family member to change. So I agree with him. On his point about entrepreneurship, I think he meant to say 51%, would go to the family member, not 50, 51%, so that nodding his head, so that that individual has control. But the other key point that he was underlying there is that the family member has to go get outside financing. You can get from the family, but you have to vet the concept outside. So you're inculcating a culture of intrapreneurship with a structure that can help you reduce the beta, reduce the risk by getting the CFO, the finance, the accounting, all the back office to support you to make sure that you get to another level and succeed. But you still have to get a validation from the outside market, which brings me to our third point here as we're going down the top 5, outside board members. If you were underscored, Denny, what's one of the most important thing, and highlight it and circle it, make it dark, and then neon light it, is outside board directors. If you have a family enterprise or even a foundation, or name me whatever structure that people are listening in on, you need third-party individuals on your board who can give you the time of day. I'll give you a concrete example since we're having a kind of a forum session here, a YPO CEO style. We adore our sister. She's really smart. All 3 of us have gone to Harvard Business School. But there came a point where I was running publishing and my brother was running our investment division. And our sister is an owner, right? There's different circles. There's the circle of ownership, the circle of management, right? And she was in the ownership circle. My brother and I were splitting the owner and manager role. And she came and she said, look, I want the same compensation. And, I've been working in the business for 20 years, was now running all of our publishing group. And I was like, wait a minute, right? And your initial reaction is, you've got to be shitting me, right? This is just not. But as opposed to having that conversation, we had it with an outsider, John Ward, who's a professor at Chicago University, and you know him, Denny, very, very well known fan of the business. And he acted as a moderator. And what we found out, my initial reaction as a business person was like, there's no way, look at the comp scales, I'm running the company, what are you talking about? And it wasn't about that at all, Denny. It was about a sense of validation that we're equal on the ownership circle. And that would not have come out without a third-party board member, observer, strategist, to be able to say, this is where your sister's coming from. It's not a business discussion. It's more of a human valuation, us 3 together value comment. So, and that's just one example, Denny, but the outside board directors consistently, time and time again, bring such value. I mean, both of my companies are private, and I have outside board directors. It makes you a better manager, a better investor, a better owner. So as a family, whether it be philanthropy or for-profit, my brother and I cannot underscore the importance enough of having outside directors, really good outside directors that can bring value to your deliberations on a multiplicity of fronts.
The fourth point is what I call the Rasputin effect. And I have seen it through my companies, and I've seen it through other families like crazy. And I refer it that way because it's you start developing this trust, and you hire somebody that you need that really fills the void that you're missing on what you think is a weakness of yours. And you start counting on these people, and they're amazing, and they're doing stuff like that. But I mean, I see it time and time again, you get blown up by this. And I've had 3 of these people in my life, and I've gotten blown up 3 times. I mean, and it's been painful. And I see it with these other families where they have relationships with key people, and they're vitriolic to the rest of the organization. And what I've done for me is that from now on, I've said, okay, I suck at hiring the CEO or whatever that I need for this organization. I'm going to have outside people interview. I'm going to be the last guy, and I'm going to sort of like vote yay or nay, but I'm the last guy to bring these guys to the table because I have gotten so burnt so many different times. And I see it in so many families. These guys take a position of power, and they feed you exactly what you want to hear, and they're not feeding you the truth. And down below, they're crucifying the companies. And I see it over and over again. Sorry. So
let me jump in on that one. I think you have to be also close to your people, Benny. And again, we're mixing up here the family holding versus if you're running an organization, right? And that's why I come back to the point about the outside directors. You need to really stay close to your people, no matter the organization you're in, philanthropy, for-profit, operations, non-operations. And you'll find out if you're getting a Rasputin effect by going to seek. My brother is a huge heart, and he has a tendency to hire really great people. He's got an amazing nose, much better than mine, of being able to delineate trends and where we should be as an organization. I mean, the whole roll-up of radio that we did in this country, in Canada, was thanks to my brother's idea. But when it comes to people, he has a tendency to give him the car keys and tell me how it's going, right? I have a tendency to get in the engine and figure out, what's going on inside the car. And I think that's why we make good partnerships. But coming back to his point about the Rasputin effect, you can't just give the car keys to any one individual and never check in with everybody that's involved in the production and manufacturing of that vehicle, as an example. So I think your outside directors, a process that he's put in place for himself, but it's also stay close to your people. And no individual in your organization should take on so much authority that there's no check and balance. There's no bellwether to find out what's going on inside the organization.
I think the Reagan sort of check, trust but verify. I think that's the key on that one. And for the fifth one,
yeah, the fifth one, I would say and this is something my brother and I have fallen into, and our sister is a partner of ours. She's much better at this than he and I are. We're both consummate entrepreneurs, and we have a tendency to go all in. You read about these stories, and people are much more successful than we are who have gone all in, right? Well, that's kind of our tendency. And as we're getting on in years, we've learned that the summation of the fifth lesson is put some money aside, right? I mean, when our father was building up telemedia back in the early days, my brother mentioned Cantel. People probably don't know this, but our father brought Ted Rogers to the table. So Rogers Cellular was thanks to my dad saying, "Hey, Ted, you should come in on this." And there was a fork in the road where my father had to decide, there was cellular and there was publishing. And my mother said, you have to make a decision. You can't do both, right? You got to keep some money aside. You can't do both. And my dad wanted to do both, but he had to make a decision. And so he picked publishing and he sold his shares of the telecom to Ted. Why am I sharing this story? My brother and I are the type to pick both. And we go all in, right? All in. And as we're getting on in years, we've realized my sister is far more conservative than the two of us and more wise, I think, than the two of us in this regard, that she's put capital aside. So you're looking at two consummate entrepreneurs who started multiplicity of businesses, and here we are going at it again. And we were learning late in life that, oh my God, put money aside. This is back to the previous speaker about Scotia about diversified portfolio. We do this, but goddamn, when it comes down to the check and hey, we can expand into Asia, we can do this. Okay, well, we're in. And that's a dangerous thing to do when you're always in all the time. You got to keep some reserve. You got to put some aside. Because I think that
you don't touch, and you don't touch your wife or somebody else to manage, and you cannot touch that. That's got to be your cash flow. That's got to be your cash flow, no matter what.
And he and I have, and I'm speaking for myself here too. I went all in, and you know what, Denny, you look at our background and go, wow, you've built so many companies. In many ways, I can speak for myself stupidly, right? Where you just put it on, and then you borrow on top of it. Yeah, because we can make it bigger, and it sounds great, but I got to tell you, you don't sleep much. And it's just the stress load just goes off the crowd. So the point here is put some aside and don't give personal guarantees. The other thing too that's happened is that banks have a tendency to approach us and goes, well, you're who you are. We want a personal guarantee. And some other entrepreneur, they're not asking for it because they know it's not the same validation. I've learned now that I go, no, I'm not giving personal guarantees because the numbers can get really huge. And it's like, do you believe in the business or not? If you want to back it on that basis, just like anybody else, then back it. If not, that's your decision. So I learned a very careful point here about putting some aside, not going all in all the time, and also not giving up on personal guarantees. I think it's a mistake to do so. Just because you can doesn't mean you should.
And you are 3 siblings?
Yes, my brother, my sister, myself.
And I spoke to Nanon at some point in Vancouver. I think, what's interesting is that each and every one of you is like constantly doing something and very well respected. And that's not taken for granted. Do you think that's because, many next generations, some of them wouldn't need to try hard or start a new thing or, maybe they'll just do philanthropy. but it's not the case with you guys. Do you think it has to do with the fact that I know that your father and your parents wanted you guys to really take education seriously? I know you're not prepared for that question, but I'm asking you. Do you think
I'll kick it off.
Important in your family?
I think it's brainwashing. No, seriously. We have exceptional parents. Like, just you know them, Denny. They started the Business Family Foundation. They've studied this, and when they started studying it like 30 years ago, there were no courses given on family business or even what you're doing now with wealth management and family enterprises and family holdings. None of that existed or was studied back in the day. Now, you know, teaming up with Harvard Business School, teaming up with HEC, teaming up with a whole bunch of other organizations to study. So we were raised on, you know, we don't care what you do as long as you're the best at it. Maybe as a father now, I've learned that maybe that's not the best advice to give to a child, right? But still, great. Yeah, that's a lot of pressure. But great parents, amazing parents, and they, you know, they fed us that thrill of building. I mean, there's a reason we're the 14th generation, right? I'm talking the 15th now, my two girls, and it's about giving them a passion about life and giving back and building and responsibility and what you can achieve. So I think we were fed that, weaned on that from a very early
dinner table. They shared the highs and lows, the excitements and all the rest of that stuff. I mean, you know, they involved us in the businesses from a very young age. And I think that's the thing. So it wasn't, you know, a lot of families have a tendency to talk about wealth and management of companies as if it's sex. You know, we don't talk about that. It's put aside in the corner. And what we try, I think, and kudos to my parents on this, is they were open with us at a very young age, and we understood what it was, and we got involved, and we got to sit on board meetings, you know, at 16, 17 years of age. I mean, that's the type of stuff that really, and it instilled a desire to succeed. Now, the only thing that I would say is, you know, don't be, I mean, your point, don't be the best. I mean, you know, try, be the best, and surround yourself with the best team possible. I think those are the caveats that I'm trying to sort of like say to my two sons, because if you're sort of saying you got to be the best, that's at what? I mean, you know, there's different bests and different things. And so I would say, okay, be part of it, and don't bite too much off, because the other thing is, I can do this, I can do that, I can do this. And so, I mean, if I had to do it over again, I would do it with a hell of a lot less companies and more focus. I mean, something instead of, because I found that when you do a startup, all companies go through the same pattern, whether it's in tech, telecom, oil and gas, whatever. If it's a startup, they go through the same things, and they all surprisingly need cash at exactly the same time, which is also very painful. So anyway.
Just to build on my brother's point, Danny, I would say, give it your best effort. That's what I'm telling my two girls, right? I want it, because you know, Denny, if you're giving it your best effort. Everybody on this call knows that if you're really giving it your most, and that's all that we can expect. To ask you to be Wayne Gretzky every day on every topic is impossible. In fact, I would say the mark of a good leader is humility, because your chief financial officer knows more about the finance than you will. Your chief marketing officer, your head of sales, I mean, everybody's going to be their expertise. They're going to be better than you. By definition, you cannot be the best. But if you can bring them together and give it your best effort, that's really where it lies. So I think that's the change I would say. But we were weaned on it. And involve your children. I mean, my brother talks about sex or politics, if you want to use it, that terminology, but involve them in the business, and be transparent about you know, I tell my girls, right, it's stressful, right? Because my other business is Zoom. So we're the largest media company in gyms in the world. Well, the friggin' gyms are closed, right? The UK I was doing great until a week ago. And that's all shut down, and Canada shuts down, opens up, shuts down. I mean, it's just a mess out there. So you do the best you can. I always talk about two circles, Denny, it's the circle that you can control. It's a smaller circle. And there's the bigger circle. Like, who's going to be the president of the United States? I have no say. Are they going to let the gyms open? I have no say. So you operate within the circle that you can control, and you give it your best. And then you have no regrets, Denny. If you give it your best, it's not like, oh, I coulda, I shoulda. No, I gave it everything I had. Then you're okay. You can sleep on both ears eventually.
And as a side note, you mentioned John Ward. It's interesting. Strauss, one of Israel's most famous families, he was the one that advised them and separated. They did want to have one of the family members did the company, which was very painful project, but he's the one that made it happen. So it's she's by the way very much involved with us. So COVID and everything that's going on, crazy. How does that affect your world?
Well,
businesses.
First of all, COVID is good for the next, I'd say, 18 months. Okay, I mean, I'm not expecting any back to normal. I mean, until the summer, and it's the start of it. So, and I've been listening to the other speakers. I think it's 2022 when things are back to normal. We're going to start seeing normal, a little bit of good normal in the summer, but only the beginning of it. So, and it's crushed. I mean, so many friends, so many industries. I was just talking to a friend of mine who's in Paris, who has one of the largest clothing manufacturing, and he's doing incredibly well because he supplies to Lululemon and all these other things which are in high demand. Well, Paris just shut down. So these orders that he had hundreds of millions of dollars of, he's screwed because he's promised these orders and there's no way of getting to deliver it. So the next 9 months are going to be bloodbath. I mean, I think COVID's going to be worse than ever. I mean, you're seeing the infection rates in the United States over 107,000 yesterday, and you're going to see them at 200,000 before it's done. So huge issue there. Hopefully they're not going to close down the country. That's because I think we can't afford it. We just cannot afford it anymore. But what does that mean? I think there's huge opportunity, and it was also reflected in a few of the speakers beforehand. I think the key things that I'm seeing is real estate is getting hit, like, and one of the speakers talked about, sort of the REITs and stuff. I think there's going to be still even more of a bloodbath in the next 6 to 9 months. But if you can weather it, and what I mean by that, have enough powder dry to cover the cost. An example, a major institution in Canada has a $12 billion portfolio of commercial real estate. They want to get rid of it. You could buy it for $2 billion right now. The problem is it's going to cost you about $500 to $800 million to carry it until it gets better. Now, it could be $1 billion, could be $1 billion too, but I can tell you that in 4 or 5 years, that's going to be worth $7 billion. So those are the types of plays. Now, other plays are very dangerous. You buy Cirque du Soleil. Cirque du Soleil, I'm not sure that's ever going to recover. Now, it's a great strategic financial deal, but is it going to survive long enough? Because it's going to cost $300 million to carry it into. And when are people going to go back into major, under the tent events? It's going to take a while. And
let me jump in. Let me jump in because my brother and I agree on many things, but we disagree on some. So I don't think, Denny, you expected me to quote Aristotle during this talk, but Aristotle said that man is by nature a social animal. We are all human beings. We're all doing this on Zoom. I have to make you laugh. I own Zoom Media, but I don't own Zoom Telecom. I had a YPO call me and say, hey, since you're the owner of Zoom, we want you to come talk to our conference. I was like, you got the wrong guy. So everybody else is dialing in, but we can all agree, Denny, this is not the preferred mode of communication, right? I was averaging 4 or 5 flights a week. And now for the past 6 months, I haven't taken one plane. It's just crazy. And we do best when we're physically face-to-face. This conference is much stronger when we're all together, be in Toronto, New York, wherever you're having it, than this. You've done an amazing job, and kudos to you and your team, but it's doing the best we can under constraint. I can promise you this, whether it's Dr. Sarah Gilbert from Oxford University Vaccine or somebody else's, it's coming, right? I mean, Bill Gates used to say it takes 5 years for a vaccine, then it was 18 months, 12 months. Now they're shipping, right? We know that it's shipping, and to my brother's point, we'll be getting it early next year. And I agree with him. I think it'll be Q3, Q4, really, by the time we start getting some sort of little normalcy. But my point is, once the vaccine is in place, human nature being what it is, we will rush back in. So I believe that Cirque du Soleil and all these things, Carnival cruises, they will come back. His central point there is dry powder. Ladies and gentlemen, you got to get through the storm. And I'm just telling you right now, Denny, it ain't over. This storm is going to rage more before it gets better. It will get better, and it's going to hurt more. But I predict that we're going to have an amazing economic recovery in 2022. I tell my teams 2022 is going to be our best year ever. It is. I'm just telling you, best year ever. But you got to survive to get there.
I like to say that COVID-19 has made us be way closer to our loved ones, which is why we love them less now. And suddenly, suddenly you're like saying, you know, my kid is not as smart as I thought. Actually, it's pretty annoying. But no, I'm just kidding. It's just, you know, I agree with you. It's a social. We are all about doing conferences and meeting people and being social. That's the heart of what we do. So I totally get it. I mean, okay, and what else do you see? I mean, so we have to.
I'll jump in on one here. I'll jump on one. When you have a crisis, it exacerbates a trend that already exists. It just makes it go faster. So the migration to digital, and my brother's going to talk about AI, but I'll talk about the digital part. And you had a lot of great discussions on AI prior, but you know, Sylvain Duranton was a great, amazing speaker. But my point is, the digital migration is accelerating. So my brother and I used to be large radio broadcasters, one of the largest in Canada, the largest magazine publisher. We got out of that business because we see the changing, but all of that print side, all that, everything is going faster and faster digital. So I'll give you an example. One of my businesses is, you can see the screen behind me. We do AI for digital billboards. So Times Square, Piccadilly Circus, we activate the screens based upon who's there, who's in front, right? And when you download an app, Denny, and you say, I agree, you're giving us permission to all the people or participants on those apps to share that data so that we can put the relevant information. My point is this: migration to digital out of home, digital anything you want to fill in is accelerating tremendously. And the previous speakers that talked about AI, I'm going to kick it over to my brother now, that is going to just take on exponential growth. Migration will be compressed. What would have taken 5 years will now take 18 months, 24 months. You're seeing that change rapidly happening. So Gatsby, back to you.
Well, Thomas Friedman talks about, you know, how adaptability, and it used to take 200 years for a change. Then it was 100, then it was 50. Then we're now down to 15. The problem is everything's now down to 3 years. And so, and François, you talk about the migrations, and there's two migrations that I want to really focus in on. One is the fact AI, and we talked about all the, you know, that issue previously, but what people are failing to realize is AI is going to wipe out, I would say, 60% of most jobs. Wipe them out. And, you know, truck drivers, transportation, lawyers, accountants. I mean, all those things are going to be done through AI. I mean, I think even doctors. And that change is going to happen. All right, we debate this all the time.
I'm gonna jump in, but I'll let my brother finish because I respectfully disagree, but keep going.
So, but that is a massive turmoil, because where are those guys going to get new jobs? It's not the people that are over 60 that's the problem, because they've hopefully had their career, have money aside. It's not the people that are in their early 20s, because they are part of the new generation. It's the people in the middle who have spent their lives doing one thing, and they're going to try and relearn something else. I think that's chaos of massive proportions. And then just to add to this equation is the whole environmental stuff. You're watching the forest fires, you know, out west. You're watching more hurricanes this year than ever in the history of recorded history of weather patterns. Then you are going to see mass migration that is going to blow everything that we've ever seen. And I mean, and what I'm saying is, like in Africa, we're talking about 100 million people picking up and moving into Europe. But it's not just Africa. You know, North America is about to see that from South America. Temperatures in Guatemala and Nicaragua, all these places, people are moving north. And, you know, and we can talk about Trump and on politics and all the rest of the stuff. But you know what? Having a border protection preventing these people to just suddenly flood the country, and we're talking tens of millions of people, these are things that are going to happen in the next 20 years. And it's going to be, so AI's coming, you've got mass changes in the weather and mass migrational movements. Huge opportunities on one side, but if you're not ready for it, it's going.
Oh, we just lost my brother. You went to mute. But let me just jump in, Denny. So first of all, my brother makes these sweeping generalizations, and I told you he's got a very good nose, okay? But sometimes he's off the mark. So I agree with them.
And we've been working together for about what, 35 years now?
Yeah,
so
I agree with them. There's going to be massive changes, and I think anybody on this call would agree with that too. I think on the AI replacement, I'm going to say something a bit harsh. If your job doesn't require a lot of mental acuity, you're at risk. So if you're a truck driver, and we use trucks, it's great, wonderful. But if a machine, and as you know, in Nevada, they're testing it right now, can drive on a highway from a warehouse A to warehouse B without having a human operator, and the technology now is getting better and better and better. In fact, they're even talking about planes doing the same thing, and drones that can fly you, and they're testing that as well. My point is, if a machine can do it better than you, you're in trouble. That's it. If a machine can do better than you, you're in trouble. If it's creativity, if it's management, if it's leadership, if it's poetry, yeah, you're okay. All right. But if a machine can do whatever you're doing right now, you're in trouble. And my brother is right. There's going to be, I can't remember the latest statistic I was reading about how many truck drivers in North America, but that is a breed that in the next 10 years, if not 5, are going to find themselves in an unemployment line, because you're going to be making these trucks that can drive from point A to point B, that don't sleep, that don't veer off the highway, that don't have it's just a much more, and drive it from 2 a.m. to 6 a.m. or 5 a.m. It just makes a lot of sense to everybody on this call. And if you're looking to invest, that's obviously an opportunity. So AI is going to continue to change many things, but verticals where the human mind is just not being utilized. That'd be the point I would say. On the migration, I agree with him again, but I also see his opportunity. My brother sometimes points to these things like dark, and I see huge opportunity, but you have to be prepared for it, and you have to plan ahead. And whether it be Canada, United States, or Europe, to use just those 3 areas, there's going to be a lot of people knocking on the doors. And we can see firsthand what happened in Europe when you don't have a plan, right? It's not good. And so more of it's coming is the message that he's giving, and I happen to completely agree with him as well.
Well, and the key thing is there are more trends than ever, all right? It's not going to be on the old technologies and everything else. There's going to be more opportunity now for new innovation and new creation than we've ever seen in the history of the world. That's the real positive of this stuff. And so entrepreneurs, you're not going to be able to get a job with Ford anymore. The real jobs are going to be creation of new companies, and entrepreneurs seeing Bob being able to create a company and saying, Bob created that, so Joanne, I can do this. Sort of thing. And that's what we've got to encourage and support. And that is the big thing that I don't think we're seeing enough of. And because it's not going, there are no more jobs for young people. 50% of young people don't have the jobs. And is that going to continue? I think so. So it's better off creating new companies and encouraging them. So this is what I'm really pushing on. So
Danny, what I would share is that there is tremendous opportunity for younger minds to find solutions. I'm naturally an optimist, and just to build on my brother's point, we as a family, and I'll let him talk about the other initiatives that we do, but we have a foundation and we strive to give back. And one of the things that we do is called Aquaforum, is where there's a lot of freshwater challenges in Canada and United States, but a lot of Canadians, we're a blue nation, and we think that our waterways are amazing. I don't know if you know this, but if you take a sample from the Hudson that surrounds a little island called Manhattan, and you compare it to the Ottawa River that flows by our nation's capital, the Hudson is 6 times cleaner than the Ottawa River. Why? Because both in Ontario and Quebec, we're dumping raw sewage into it, and that's just the tip of the iceberg. There's a whole bunch of issues going on with our fresh water in Canada. So we, as a family, have decided to dedicate our time and resources to help find solutions that every municipality across this country is facing with fresh water. And what we do is we create something called aqua hacking, which brings all the young minds of Canada to find the solutions listed by the mayors and all the people saying, I've got a problem here with my fresh water. And we turn to the tech side, that's what we call it, aqua hacking, to find a solution. Well, from that, 86 companies have been started. of which I believe like that time I checked, like 63 are still operating and going to finance and find a profitable way to find solutions to these challenges. So I'm an optimist, Denny. I think that we have big issues coming our way, but I find that the human spirit and the human mind is just unbelievable when it's correctly harnessed to find those solutions. So I think our best years are ahead of us, not behind us. And I think people get really dark. If you get really dark, I'm a student of history. George Centennial said, those who do not know their history are doomed to repeat it. We are living the dream right now. I know people go, oh, it's dark out, it's terrible out. No. Literacy is higher, life expectancy higher. You live better today, Denny, than you did as a king 300 years ago. It's just that we have to address the issues that we're facing and not run away from them. And the human mind is amazing at finding solutions, correctly harnessed. So I see our better years ahead of us, but we have to mobilize.
Any other remark regarding the environment?
Well, I mean, look, I think the other area that we should be looking at is healthcare. I mean, because we're getting older and people want to look younger, be younger, feel younger. And the key thing is trends. We see trends. And one of the biggest trends that we're seeing is the biggest lawsuits in the world in the next 20 years is going to be on hearing loss. So what are we doing about that? And people, as they get older, are losing their hearing. So we should be addressing that. I mean, these are fundamentals, and we know how the impact on the mental state of people as they can't hear. I mean, so, these are things that we should be following up on trends. And my brother was talking about Aquaforum, but we've got 4 foundations, and one of them is on family business, and we've got 10,000 families we're involved in. One is on education, and we're digitizing, we're paying for the digitization of Harvard's library, which is the largest in the world on business. And so we're making that available to any student around the world because it's information getting out to people, and that is what's going to change the world. So, and the key thing I would say is everything that we're doing, we're trying to be global, because we're no longer a local, doing only local things. If you can reach out and create products that are a global demand, then this is the new environment that you should be in. And that's the fundamental focus of what we're trying to do.
Just one thing, Denny, on that. My brother believes in global, and I agree with him, but I think you have to cut your teeth locally. And what I mean by that is, so sometimes we have a tendency, I've seen too many businesses go south where they say, okay, we're gonna go pan-USA, out of the gate, pan-USA. I'm like, whoa, let's make sure that we have this working right in California or Seattle or wherever you want to start your local, or Toronto. So the point being is, cut your teeth locally, really hone it so that it's working well, and then expand globally. And you're going to have to adapt. I mean, if you're in China, it's very different than if you're in Japan, very different than if you're in Detroit, right? But you have to cut your teeth locally and really wean the process out to make sure that it's working well before you go global.
Where do we go from here to summarize our discussion?
Well, I mean, so look, my main focus is, I think you be open, encourage entrepreneurship, encourage innovation. I mean, we are giving a lot of money to universities to sponsor an Aquaforum. François didn't mention, but we give, I think, what is it, 10,000, 100,000, François, this last year for companies to come up with ideas and give sponsorship so that they will survive for the longer term. We've got to seed. We've got to put seeds out there and have them grow and support them and get other people to support them as well. That's our future. It is not having Ford coming in to put another plant and it's going to have 400 people. It is to sponsor, 50 to 100 new students who are creating new ideas. We're going to create the next, ways or whatever it is. And that's,
well, just to be clear, I think it's both. I mean, we just, Bill, my brother's point, we put 7 million, just giving you the numbers, on bringing students together to find solutions for freshwater challenges across Canada. And we're raising more and putting more into work in that regard. But his point is, I think it's both. I think the challenge that we face in policy is that policy usually focuses on the biggest dandelion. Oh, it's Ford, right? And we love Ford, great company. But at the end of the day, most of GDP is not Ford, right? As you know, Denny, it's the entrepreneurs, it's the small and to medium-sized companies that constitute most of gross domestic product. And what we believe in is the entrepreneurial spirit. I just think the human mind is an amazing thing, and we can find solutions for practically anything. So when you talk about global warming and there's all these issues, yes, they all exist. Yes, it's accurate, but we are privy to some of the research and initiatives are going on. In this case, I'm focusing a lot on fresh water, but it's mind-blowing, the solutions. It's just awesome. It gets you so excited. You're like, oh yeah, this is going to change everything. So I look at it as hope. You just got to give the generations behind us a chance. I want to make sure that we leave the place a better place. And for that, it means structure, processes, capital. Give them a chance, because they're going to blow us all away in a good way of fixing some of the things I apologize to my daughters, some things that we, this generation, created, right? The messes that we're leaving behind, but we have an opportunity to fix and make it better. And so when you look ahead, I see tremendous opportunity. I would hope that people are listening in are, as they look at a diversified portfolio, I would hope that they would take a bit of that portfolio and say, how can I make a good return? You know, there's funds being launched in water in Canada as an example that make me an ROI, but also give back. Right? An opportunity for me to help the next generation behind me, an opportunity for me to clean up Canada, an opportunity to help my US neighbors, because we have, the Great Lakes and the contiguous borders. And I'll tell you, the drought situation that my brother was talking about in California, this is a really big problem, Denny. It's a really big problem. And we have to get involved now, because these water rights that we signed in our past that give 99 years, all the water you want. I mean, you just can't do that anymore. So I think we need to get involved. I would ask people to get engaged, whatever the choice that you wish to, whether the field that you're most interested in, and help the other generations give back and make an ROI, but also give back at the same time.
Great, Philippe and Francois, it's been an exciting discussion. Thank you so much for that. It's always exciting when we're speaking to Adegaspé, Bomia. So thank you so much for this. Anything else you'd like to add, Philippe, or?
Do you want to go first, Adegaspé?
No, I'm François. I've communicated, and so
thank
if you
so
want to.
much.
Danny, I would say congratulations to you and your team to learn to pivot, because people forget that Darwin did not say the stronger survive. Darwin talked about the most adaptable, the most flexible survive. And the fact that you and your team are able to adapt to this new world reality, good on you. And everybody listening in, I think our best years are ahead of us. We have tremendous opportunity, but we need to get engaged and to assist, not just on a pure financial metric standpoint, but also leaving the place a better world in. And you can do that and still make a return.
Thank you so much. That's a great way to finish, I think a great note to finish our conference at. So thank you very much for being here. I'm looking forward to seeing you in person. By the way, I invited Philippe to speak at and get involved at our Emirates event that we do. It's a lot of entrepreneurship and Israel and peace and all of that. So a lot's going on. We should talk about it as well, Francois. So thank you so much for being with us, everybody. Next week on Tuesday, I have a conversation about what's going on in Europe, with Gina Miller, a known activist and one that fought against the Brexit very much there. And on Thursday, we open the US Family Office Conference with amazing speakers, John Katsimatidis, major real estate family, Kennedy family, Rockefeller, the heads of AI at Google, sorry, not Google, somebody's calling me and somehow it became Google, sorry. NVIDIA, Levi Strauss, Microsoft, H&M, and others. So thank you everybody for being here. Thank you, Francois and Philippe, for doing a great final discussion here. And we hope and looking forward to seeing you in person. As you know, Francois, Philippe is highly involved at our Montreal conference. It was supposed to be held this year. Hopefully we'll see it happen next year in Q3.
I'll play supporting cast member.
Please. Thank you so much.
Bye. Thank you, everybody.
Bye, everybody.
Good
Stay
conference.
safe.